So good morning, everybody. I hope you're all well this morning and you're very welcome to what is our third and our final workshop in this Angel Investor Literacy Program. My name is Larry O'Donoghue and I am the CEO of one of the partners on Seeds of Bravery, an organization called Access BIC. We're one of over 17 partners involved in this wider Seeds of Bravery project. So I just want to tell you a little bit about Seeds of Bravery, which is a hugely important program for us all. So this is it's a large project. It's a 20 million euro project. It's funded by the European Union. And the overall mission here within this wider project is to bring the Ukrainian tech ecosystem, in particular the deep tech ecosystem, closer to the European Union in a number of different ways. So the program is designed such that startups can avail of 5 different programs in the wider Seeds of Bravery project. All of these offer different levels of grant funding. A company can get a total of 60,000 euro of grant funding throughout the entire program. And these various modules and programs are designed to help startups in several ways, such as deep tech incubators. There's accelerators. We help to introduce startups to potential customers across the European Union. We help to prepare the startups for taking on investment and growth funding and introduce them to potential investors like yourselves here this morning. So the Investor Literacy Program, it's an important part of this overall Seeds of Bravery project. And just a little bit of background to my own organization and our history in angel investment. So we, in Access BIC, we've been dealing with angel investment for over 2 decades at this stage. We supported the establishment of the Angel Network in Ireland almost 20 years ago. This network is known as the Halo Business Angel Network, or HBAN for short. And we grew that network from 0 angel investment back in 2007 per annum up to 33 million of angel investment per annum in 2022. And we did that by growing 13 angel investment syndicates across the country and internationally as well. And we're also members of a wider European organization that's called the EBAN. EBAN stands for the European Business Angel Network, and EBAN is responsible for coordinating much of the angel activity all across the European Union and even beyond the borders of the European Union at this stage. So just to kick on with today, I'm going to hand you over to my colleague in Access BIC, Clara Galvao, who some of you will have met previously in the other workshops. And Clara is going to introduce you to the agenda for today. So good morning, Clara.
Good morning, Larry. Thank you. And good morning to everyone today here who are logging in from diverse parts of Europe. You're very welcome. So my name is Clara Galvao, and I'm a senior consultant with Access BIC. My personal experience in relation to angel investing is in screening early stage startups on behalf of private angels. And by advising investors of how investment ready these companies are, I also consequently influence the angel investment choices. Now, if this is the first workshop you are attending for the Investor Literacy Program, you're very welcome. As a recap, and also as a reminder for those who have attended the previous workshops, you would have heard firsthand from experienced angel investors and experts on how the investment world can be both daunting and risky, but also hugely gratifying when there are successful investments. One thing our previous speakers all agreed on was that having an investment strategy and a more formal structure to investment through can reduce those risks significantly. So this is why the program was designed, to support both current and also aspiring angel investors to understand the investment landscape from a micro, macro, national, and international perspective. The program was actually delivered in 3 progressive workshops. This one is the final one. Each session had a focus theme and was built upon in the consequent sessions. In the first workshop, we gave an overview of what angel investing is and what to consider before investing in early stage startups. And in the workshop 2, we covered in detail on how to invest and operate through an angel syndicate and how you can grow your angel investor network. So today is our final workshop, and we will focus on what happens after the pitch. So you will learn about negotiating deals, due diligence, and portfolio management strategies. And by the end of the workshop, you will hopefully have a clear vision of the entire process for deal assessment and successful exits. So just to touch on a little bit of the topics of today, some of the key topics are going to be deep dive sessions. So where we are going to discover firstly what it is, and then uncover how deep dive sessions actually streamline deal analysis and decision making. On our session on due diligence, so these terms might not be familiar to everybody, but you're going to find out what they are. We will unpack exactly what is due diligence and why is it so crucial. You will learn about the deal lead's role in the process of sharing insights and managing data rooms. We also want you to have a flavor of the wider Ukrainian angel ecosystem. So the next session after that will be a panel made up of mostly UA angel investors who will share how they analyze an opportunity and come to their investment decision. After, well, we're going to have a break as well. So don't worry, we're going to have a little coffee break. But after the break, we will also hear from what goes into closing a deal. And in particular, what crucial and critical documents are needed to finalize investments smoothly. We will then have another panel, and this time is made up of founders. So some who are currently fundraising at pre-seed and seed rounds, and also someone who has exited. So I'm looking forward to this one because they're going to share both the highs and the lows and everything in between on working with angels and syndicates. On our final session, we're going to cover how syndicates go about portfolio management. As more and more deals close, it's important to strategize the management of these portfolios. So we will wrap up in the end with questions and answers and point you to some upcoming events. We want to make sure you get a chance to practice all your newly acquired skills. So do make sure to register and get a front row seat to the demo days, which we will be announcing here. This is when the Ukrainian startups will pitch their innovative solution as investment opportunities to you. So stay tuned. Okay, so for now, for our first guest, can you change the slide there? Yeah, great. We'd like to introduce you to Donna Kiernan, who is the Managing Director of the Bull Syndicate and CEO of Tenego. Hi, Donna. Thanks for coming and joining us.
Hey, Clara.
He's going to walk us through what happens after the pitch and elaborate on deep dive session. So the floor is yours, Donna. Welcome.
Very good. Thank you, Clara, and thanks again for the opportunity to talk through these topics. So I'm sharing my experience so far today. So I came in as manager of the Bull Investment Syndicate at the start of this year. And in all of this, kind of, even though I'm in the industry a long time, I'm learning an awful lot from people like Larry, like Ivan, that you're going to hear from this morning, and others in sort of this activity. So what I'm sharing is basically how we're taken on to go through the deep dive and what's the point of view from the angel investor and from managing the syndicate. So in this, a little introduction into Bull. We invest mostly into medical devices, life sciences, clean tech, climate tech, and ICT, IT, generally speaking. A little bit about us. Larry talked about the Halo Digital Engine Network, and Axis BIC or Corkbic back then was actively driving the creation and what is sort of the Bull Investment Syndicate today. Kind of with ongoing, maybe 30 to 50 angels, kind of we have 30 active investors at the moment, and we're planning to grow that to 50 by the end of next year. We're looking to invest in 8 to 10 projects per year, and each round is in the region of maybe 100 to 300K. So just how we operate. We are a not-for-profit organization, and with a nominee structure with the funds pass through and hold the shareholding in trust. And that's how we operate. Low-cost operations, so everything is about streamlining the processes, making it as simple as possible just to get things done. That means standardization, that means automation. So everyone understands why we're doing it and kind of to make it as efficient as possible. We're trying to professionalize everything. So we don't depend on voluntary effort if we can at all. So when angel investing, and we do need deal leads, so they are stepping up to help with their time and effort. But we want to drive the process and we want to drive growth. And we want people's time to be rewarded through all of that. In creating a sustainable model, even though we're not for profit, we want to be sustainable. So we have an annual membership fee, and then we have transaction fees, investment arrangement fees, but also a certain amount on the exit, kind of that happens as well. And we think we'll manage with that, but we're still reviewing that process. Our entire approach here is about making it easier for investors. We want to get angel investors involved. Some of them are very busy because they may already be running companies or in corporate jobs or doing what they're doing. And we don't want to overburden them with too much of what it is to learn about a company, because it's challenging to look at so many companies and decide what to invest. So everything's about bringing the right projects to them and give them in a format they can easily digest and understand whether it's relevant for them, and then how do they learn more about kind of if they want to invest. And then make it easy for investees. So these promoters, founders have a challenging job in raising funds while running their business. And we understand sort of they're putting themselves out there. It is difficult. So we want to be able to communicate easily, regularly, and try and get decisions as quickly as possible, or give them relevant feedback all through the process. And the entire Boole Syndicate and all the angels and the members understand that we're there to support the founders through that whole process and ongoing of the business, of course. So before we get into deep dive, just to put it in context. So we have the angels and we have Boole. So we have a pitch meeting, and then all of these projects are pre-vetted, coming in with support of Larry and Access BIC, kind of coming in. Every one of them are investable. So every quarter we might have 4 or 5 pitches, and kind of given that in a format that the investors can decide on. And then following the pitch, we're getting into the deep dive. I'm going to get into detail on that. And then after deep dive, we have diligence, kind of invest, monitor investment, and then exit. So I'm not going to detail in each one of these steps, kind of that's where it all flows. I'm going to go into the deep dive. To get to the deep dive, we have to get beyond the pitch. So how do we decide if a company that pitched that we want to do a deep dive with them? So firstly, as an investor, are they interested in hearing more? And how do they decide what questions do they ask in the pitch to be able to decide if they want to hear more? So we direct our members during the pitch session to focus the questions to determine their interest in investing, right? The question for information. They don't offer advice. So we want to consider you have a pitch for 20 minutes and you might have 10, 15 minutes Q&A. You want to keep the questions focused and you don't have much time for discussion. So we're trying to be very efficient in all of this. So sometimes we have investors with vast experience and says, why did you try this or that? That's not what we want. They ask questions, deliberately decide, okay, are we taking the next stage or not? That's it. In that though, as always, we're asking the investor to be very supportive of the pitching investees. So if they get an answer that frustrates them or a lack of clarity, they have to be patient with that. And if they're not getting the answer they wanted, then they just have to pause and park it. If it's, as an investor, if it's not for you, you just stay quiet. You don't have to explain all the reasons why it's not for you. You don't express your opinions, why you find wrong with it. You don't be negative in front of all the other investors, and deter other investors, because people make their own decisions. And as angels at the table, supporting each other, their expertise, that could be in an open discussion after the investee leaves to decide where the interest lies and where the challenges may lie. And that's not to impact or influence other people's decisions. It's just to provide information. So we have to monitor opinions and ask members to be conscious of that. Then how do we know we want to go a deep dive? So firstly, in managing the syndicate, we have to make sure there's enough interest, enough investors interested with enough potential money on the table that we're going to meet a threshold. So in Boole, if we don't get 100,000 or more of potential interest, then it doesn't meet threshold. That is our threshold. That threshold is set because below that, the cost of doing business over the years, not just on this transaction, it becomes prohibitive. And then as an organization, challenge our sustainability. From investors, whether they like the pitch, they maybe ask some clarification questions in the pitch, but now they want to go deeper into certain things to verify. And that's basically the criteria. I'd say from a syndicate point of view, the number of investors is what's most important. The amount may not always be committed at that stage. It's not committed, but sometimes it's not always clearly indicated what they might have available. So you have to decide based on the number of investors. And if there's borderline, we hold a deep dive. And sometimes in the deep dive, we might get other people involved as well, because we're recording everything. We're recording the pitch, we're recording the deep dive, and we can share with people that couldn't attend either. So sometimes we hold a deep dive if there's a reasonable interest. It may not be enough, but if it's reasonable, we are lenient on that particular point. There's a certain amount of regular standard information you want to know about the opportunity before you get into the deep dive. And this is the basics. It could be in the pitch deck or gathered alongside the pitch deck that's coming into this. And every investor needs to know the basics here. So I'm not getting into any of this, but we can talk further if anyone has any questions on it. Okay. The last point is just from the syndicate management point of view, the expected round close date. And that's when people are asking, when angel investors are committing funds, they need to know when they need to have the funds available. So we're trying to be able to communicate that as well, because sometimes they're coming into the end of the year now. Some people have so much available for this year, and then we might have some opportunities that's closing next quarter. So that's easy to be able to decide what they're committing out of this year's investment budget or going into next. In the deep dive agenda, there's a lot of points here, and it's really getting into, this is what I've shared into investees coming into the deep dive session, is to prepare a deck going through to just remind people very quickly of what the business is. And then some people coming out of the pitch session, we would have asked them if any questions that they want addressed specifically, and they would have been shared as well in preparation for the investees to coming into the deep dive. Then the Q&A then, where it gets interesting. This is where it gets very fluid and depending on the activity. So here we have the investee, and then we have a number of potential angels that are interested in us, and sometimes our deal lead are coming from that group. They may have been decided at that point, or they may not. So firstly, I want to make the point of just enough assessment. So for example, if you're an angel investor and you're investing 100,000 a year and you want to put 50,000 into 2 investments, then you want to do a lot of validation before you put 50K. But we would encourage people to more of a portfolio approach and spread their investment. So if it was 100,000, how about 10 10s as opposed to 2 50s? So then you just do enough assessment on the opportunity based on a portfolio approach. So, and then the attitude coming in here, are we looking for all the things right, managing the risks, or are we looking for all the reasons not to invest? So there's a certain approach that portfolio approach, that how much do you really need to do based on what you're investing and how much you're spreading the risk. And also, Boole is typically never the investment lead. So if we're coming in with 100 to 300K, you might have other organizations coming in for 500,000, 1 million, and they're leading investments, so we're depending on their expertise. A bit like Ivan in the medtech syndicate, if they're leading and the activity, we trust other people involved as well. So you're looking for details of the deal, you're looking for the plans and milestones and the risks of the business as the investee sees it. But some of the categories you're seeing here are very much due diligence categories. So you're really asking questions across different areas that might highlight something to be dig deeper in a due diligence phase. Or if you find that you're not getting full clarity from the investee, that these are areas that you're looking for validation, details, proof going forward. So again, it's highlighting certain issues that may be looked into further, but really you're digging into how much the investee has thought about their plans and talked to this. It's difficult to be very prescriptive on exactly what questions are asked because the projects vary so much. In the pharma and medical device space, as a startup, is very much about the product development. And so you're looking into the science. kind of how much of the science is right, how much of the IP is right, kind of, and all the ownership issues around that. And then how do you trust kind of they're going to actually execute on these plans, the milestones, and the details of those milestones? The plan never works. Every investor knows that, and every investee company knows that, but they have to have something to work towards. And the team, and understanding who the team are and their capabilities and their ability to execute is being questioned. So when you have companies that are actually in the marketplace, sometimes they're more challenging, because then can we trust the numbers of them delivering sales? And I find that funny. So the pharma and medical device companies, they're obviously, they get off easier because, yes, we all know the product development cycle and the science can be validated and all this sort of stuff. And we know what FDA regulations and such other regulations get into market. You know what that process is, but they're not challenged on go-to-market in most cases. Where companies that are actually in the market, they're challenged heavily on go-to-market, and people can find greater risks in those areas because there's a greater number of unknowns to a point. And then some things here about the individual that's presenting. Do we like them? Do we think we trust them? Do we want them to be successful? Do we want to be part of their success? Are they coachable? There are many angels talking about yes, they may have expertise, the angel may have expertise, but if the investee is not willing to listen, then are they willing to learn? And that's a big challenge when it comes to the individual characteristics. And we've seen confidence is great, arrogance is not, right? So and you want people to be strong in their commitment, but the balance that they're able to listen to good advice and to be able to take it on board, form their own opinion and view, but to be able to listen and challenge other people's thinking also. So that's a set structure across these things, right? The other thing going into the trust part of it is how transparent are they? How open are they in the way they communicate where they are in the business, what their challenges going forward? I typically have a challenge with very charismatic people because they can talk their way out of difficulties, and they can very, very good at being persuasive, but hiding maybe real issues in there. So again, this is back to the personality, but it's back to the ethos that they want to create for their company, and then how they're going to treat investors and others in that company. So I think the whole transparency and trustable, likable stuff is very important in the leader, because that's what people are really investing in to execute on the business. Following the deep dive, then we're getting into the point at we're asking the angel basically,
Thank you so much.
So we're asking the angel investor, okay, for everything you've seen now, are you ready to invest? And depending on how much commitment we have coming into the deep dive, we may have a large number of yeses, and you may have some drop off for whatever reasons, and then you're asking people to commit, investors to commit at this stage. So if it's 10K, 20K, they're going to put into the business, okay, I'm ready to commit, and that is a commitment. And we want them to hold that commitment, not legally binding, right? They may have their own reasons, but we want them to be able to put those funds aside, ready to go into this particular project, subject to due diligence. And then in the due diligence phase, it's back to you're going to invest as committed unless the due diligence has shown up very relevant issues. And again, we frown on people backing out of their commitment, but we can't force anybody. So I think it's important from how we operate and what we can commit to investees that we asking the angels to invest. So other than that, then we're bringing through the process. But I hope that gives you a quick overview of the deep dive stage. So Clara, I'm happy to answer any questions.
Hi, Donna. Thank you so much. Now, these were great points. I have some notes here about streamlining the process, spreading the investment, asking the questions that have relevance. I like your point about as well, plan never works. But the importance of the team having the ability to execute means a lot to you. I think what we'll do, Donna, is that we're going to, if anyone has any questions, if they could please put it on the chat, and we will, as we go along, we will answer what we can on the chat, and also at the end, we're going to have a question and answer session. But I appreciate you coming along and giving us this presentation and breaking it down for us, what deep dive means. And yeah, thanks, Donna. I'm going to
I see a question there.
Okay, let's just see.
Yeah. So there's one from Andrew. Which tools do you use for automation, the process and the pipeline? So Abby's jumped into answer that one. I can jump in, Abby, as well.
Go ahead, Donna.
Do we have time? Can you tell me if, like, in the various tools, look at we've email marketing tools just for automation, the emails and the communication. We have other online tools that we use the sharing of the recordings and be able to do this well. Then we're looking at more as we progress, because I'm still at this less than a year, but as we progress and with higher volume, then to be able to automate the documentation creation. We're using DocuSign for all signatures, for example. So that's one thing, getting away from paper, and it just speeds up the whole process. So standardizing the documents, standardizing legal agreements, there was a bit of effort in doing that up front, but standardizing the process is very, very important before automating, right? So I think we're going through lots of different areas in how we automate these things. Everything's electronic. It's as simple as that. And we can operate from anybody, the investors can operate from anywhere. And that's important to us.
Okay. All right, Donna, I'm going to bring in my new guest at this point, but thank you for sharing with us today. I really appreciate it.
Okay, well, thank you.
Have a good one.
Right.
So if anyone has any more questions, do write it down on the chat box. We're gonna get to them maybe on as we go along if we have time. But if not, we do have a dedicated time to answer questions and answer later. And yeah, we welcome it. Okay, so for the next guest, I'm going to bring in Anna Majera. So she is a managing partner with iClub Global. It has a really rich history in the entrepreneurship and investment ecosystem across multiple countries. And she's going to be walking us through what is due diligence and what we need to look for and why is it so crucial. So is Anna in?
Yes, I'm here.
Hi, Anna. Good to see you.
Likewise. Thank you for inviting me. Thank you.
You're very welcome to be here, and I really appreciate you taking the time and also sharing your expertise. I'm looking forward to your session, so I'm going to go away and you can share your screen now.
Thank you. I will share the screen. Okay. So make sure. Okay. Hope you see it. Start with it. Okay. So as Clara mentioned, I will be talking about due diligence, and I believe this to be a very important part of the whole decision-making process. And of course, it's being made a bit lighter on investors in the syndicate structure, but still, I believe it's important to trust your partners, but also to be aware that you have to make the decision and not to be shy as an investor to ask the questions, to understand everything you need about the company. So yeah, I will. So basically, what is due diligence, right? It's important to evaluate the company before you make the investment, right? And you evaluate the company from all the different perspectives. And I have prepared a checklist for you, which will be very practical. You would be able just to copy paste those questions and send them to the next companies you will be looking at. And all of these questions, they are covering different aspects of the business, and I believe all of them to be very important. I will try to, in the sake of time, to be quite quick with them, but I hope it will give you the perspective. So first of all, of course, you need to kind of dive in and understand what is it about, right? What is the core and the essence of the business, and what is the solution, and what is the opportunity there? How big can the company get? So these are, I would say, very high-level questions, but still they are important. And trust me, if you don't understand like the company essence after the pitch, and after talking to the founders or participating in the deep dive, so I suppose it's better not to invest, right? And trust me, I have been in the industry for 18 years, but there are still companies that I don't get, right? And I think it's important to get the company, to understand the company, to be able to invest and to be comfortable with this investment. Market is very important, and for example, in our syndicate, we are targeting and with the fund we are targeting the companies that are in huge markets, markets that are $1 trillion markets, and this is important for us because it assures in a way that despite the fact that there are other players in the market, we will still have a pretty big portion of it because it's just big, right? And the investors should understand everything about the market, and it's in this way, like it's not important that you are an expert in this market. The founders, they are experts in the market, but you have to understand which questions to ask the founders so that you got the same understanding of the market, right? So what is the addressable market? I would say the whole potential of the opportunity, and what is this obtainable market portion that the company could actually get at some point. And how quick could it be, right? And what is about other players, how they're growing, are they facing any kind of restrictions with the growth, etc. And whether the company have high growth potential and why. It's important to understand why, right? To get into the core of it. Team. Right, team is really important in at any stage, but especially early. Of course, it's important to understand who are the founders and what is their background and whether they are the right people to actually, bring this idea to life and get to the results they promise. Because that's usually come from their background and come from their previous experiences and previous companies that they have been working in and exiting, etc. So you need to understand the core team, the founders. Excellent if you have the opportunity to meet them at least digitally, right, virtually. But also you need to understand who else is in the team, right, and who are the people and how the team is built, and whether the expertise which is crucial for this company is in the company, right? Whether the company has advisors and whether they provide the support they have to provide. So everything about that is important, but also how the company is going to evolve, right? You need to understand, like you're participating in the round and you're making the investment. So with these investments, what will happen to the team, right? Will the team grow, and how will it grow? What people will appear, etc. So it's very important to understand the like how the team will evolve with the time. And right founders, they should be able to explain that and to give very good arguments about that. The product, right? Of course, the easiest way is to ask for a demo. Please give me a demo, show me a demo. I want to try the product, or just I want to download the product and try it myself. I want to actually use this service if I'm in the same location as the company operates. So it's perfect then. You can actually use this service and get this kind of important first feedback. But also I experienced that with our investors, for example, that they go and they read different feedbacks and testimonials just online. And I think that's a great way to to get the understanding of the product and how the customers, how the users are actually anticipating the product. So that's important, right? Not just because founders, they should be in love with their product and they will be presenting it, being in love with that, right? But you need to, as an investor, you need to see it from the investor point of view, and also to see what might be the risks, right? And maybe not all the positive things, but there are different ways today. And we are very lucky to live in the time when you can just go and Google almost everything, right? And you can find a lot of information online on the company before you go and ask the questions. So you can kind of, make your diligence and then ask follow-on questions with the founders. The tech, of course, we are talking about the tech industry. So the tech is really crucial, and you need to understand what is the team and how the team works and what are the algorithms. I don't say that every investor that invests in tech should be a programmer in the past, or have a tech background. I don't have a tech background, but it's also there. There is a lot of information out there, and we live in the time when we learn a lot of things that are not strictly of our direct expertise. So we know a lot of stuff, and I think it's important to understand how the product is built and how the team is organized. And also, it's good to have, your connections, your people that are having the relevant expertise. So in case you're having some doubts, you can always, consult them and ask them about anything, but you need to ask about specific stuff, right? And you can do that only if you get the information from the company. Competition is important, and the founders, they should be aware of all the players on the market and how they are positioned, whether there are any, people like companies that are taking the larger portion of the market, and also whether the barriers to entry are high or low. So all this information is very important for the investor, because in case the market is very saturated and there are a lot of players, so it's kind of difficult, and then you need to understand then what is this kind of unfair advantage the company has, that it will be able to beat all of those players that are out there. Go to market. A lot of startups, they, I would say, neglect this part, but it's very important, especially for early stage, because it's kind of their vision of how they're going to reach out to their customers, to their users. And if they don't have the plan, if they don't have the understanding, that's a red flag, of course. So the investor should understand the strategy and what would be the channels, and what would be the customer acquisition cost for every channel. So there are very specific questions, and I actually like then our investors for my club, they come back to us and they ask these specific questions about the opportunities they like, because they want to have a clear understanding. And it shows that they are, they understand the processes, they understand the essence of the business. So that's something you definitely need to understand before you make the decision. Traction is a key, right? So whether the company was able to achieve anything before they come to you, or they come to the syndicate. So at any point of time, there is some traction, and it's important that the company is able to present it. But of course, depending on your investment strategy, there might be different approaches to that. So sometimes investors invest only in the companies that are already revenue generating. For some investors, it's not that important. For them, it's important that the company has at least some traction in terms of users onboarded and some behavior traction of their users. But it's important to understand whether there is traction and whether the team is able to generate it early stage, and how they were able to do that. Because, for example, we had in our portfolio some companies that impressed us, being like first-time founders and coming from from Central Eastern Europe, but they were able to build very strong traction within a very short period of time, and the trajectory of growth was just amazing. So we were kind of convinced by that, and investors as well. Risks, understanding the risks is important, and usually when the company is presenting the pitching, they rarely address the risks. So that's kind of our task as investors, to ask the questions, especially if the industry is regulated, especially if there are some liability risk, potential liability risks. So all these questions are important, and you should understand whether the company is aware of the risk and whether they know how to mitigate them. Of course, having the risks, it doesn't mean that that should be a red flag and I'm not investing in the company. There should be a clear path. Okay, this is how we are mitigating risk. Then you can consider that. It's important on any stage to understand what is the end game, right? So is it the company that would exit pretty fast because they have very clear value for a strategic player, or is it a company that is for whom there is a clear path to IPO? So this is important. And of course, this is important for your investment strategy, because some investors, they don't invest in the companies that are looking into into IPO as the exit scenarios, and they prefer quicker exits. But you should be aligned at the beginning, right? So you should be aligned at the beginning, and that's the right question at any stage. Trust me, even if this is a pre-seed company, they should understand what is the potential and who is out there who might be interested within the next 5 years to acquire their company. I know founders that are starting these conversations and building this connection very early stage. So it's important that they understand what they are doing and where you are going together with them. IP is important for tech startup, right? And it depends, of course, on the product. For some products, it's not the deep of the tech, but if it is a deep tech, so make sure that you understand who is owning the IP. Are there any issues that might evolve with the time? Because this is crucial. This is the essence, and this is the part of the valuation, the bigger part of the valuation of the company. Financials is very important part, and getting access to projections, to planning, to metrics. This is what you need to do, and make sure that you have at least if it is early stage, of course, there would be more high level approach. But if it is a company that is already generating some traction, so there should be numbers in place, there should be P&L and cash flow, and all these numbers should be shared with investors to make right valuation of the company. Of course, understanding the round very precisely. What is the round? What is the valuation? Why the valuation is so? What are the terms? For other players participating? So all these points are important, and you need to understand them. So it's important to understand that early stage and late stage companies are a bit different in terms of what they possess and what they can actually share with investors. And as an investor, you should also be kind of play right here, not to overstress them if they're too early stage, asking them questions that are more like later stage, right? So there are different approaches. Like the team is crucial, as I mentioned, despite the stage. But early stage, you're focusing on whether the team is strong enough to execute. And then later stage, it's all about leadership. It's all about C-level people and who are they and where are they coming from, etc. If we are talking about the product, so early stage, it's important to understand whether the new solution, which is brought by the company, it will be actually the solution that will be simplifying how the users are solving their problems. But in later stage, it's already like if the company is big enough, they are already competing, right? So they should be strong as a competition. Market, like the size of the market is also always important, despite the size and the stage. Financials, early stage, it's more about burn rate and runway. So how much money do you spend and how much money do you need to get where you want? But when later stage, it's all the details, metrics, all the, as I mentioned, P&L, cash flow, all the numbers are important. With co-investors, like at the beginning, it just, does anybody else like it? And later stage, it's okay, what are top investors on board, right? So like later stage, the company should be able to find really strong players in the industry. And of course, defensibility, which is important despite of the stage, and whether the competitors could easily repeat this, or it's more complicated. So as I mentioned, depending on the stage, there are different things that you can check. Early stage, when we are talking about the team, so you go about background, who have been working with, whether somebody in the industry know them, are they visible in media? Do they are they considered as experts in their field? So all this stuff is actually available online, so you can actually get this information out there, and you can look for this information. Market is also something you can ask the team, but you can also make your own research and also kind of validate whether the words and the numbers provided by the team are visible, are true, and are real. about the competition, again, you can look at the market yourself, and there are a lot of information like benchmarks and different reports that are available, but also then to validate with the team. About the product, as I mentioned, IP, tech expertise, and competitive advantages, but also you need to understand whether the product is scalable, whether to launch it in all the other geographies. It will take the company like weeks and months and not years. When we are coming later stage, as I mentioned, in team, the leadership, culture becoming more important. With product, it's more important about whether the company is able to retain customers, not just to bring them on board, but also to retain them. Whether the revenue potential is high, and because when they start, it's important that they do at least something. But when they grow, it's important that the numbers are sufficient. So knowing all of that, right? So there are many things you need to understand, but I want also to kind of make sure that you understand that if you're focusing solely on the risks, then you will be choosing, it will be very difficult to choose anything, right? Because, well, tech industry is risky, and you will miss opportunities, and your investment strategy might be too cautious. So there should be balance, right? There should be balance. Ask questions, get all the information, make sure that you are making the conscious decision, but also don't overlook the like great opportunities and big opportunities just because there are some risks involved and there is some competition on the market. Very quickly, to get all this information, right? To like you get access to data room. In our case, for example, in iClub, our application is a data room for our investors, because when they open the application, they get the access to all the information about the company. So we can say that, but every company has their data room, and if you're investing in the company, you should definitely get the access and get all the basic documents and also optional additional documents if you need them to make the decision. So that's absolutely fine to ask additional information and additional questions. It's not just to get what you have and okay, so that's what they prepared, so I should get all the information from here. No, there are much more they could share, but just make sure to ask. In the syndicate, there are different responsibilities and different roles, right? So there's a lead investor who is responsible for initial screening and searching for excellent deals, then performing the due diligence, the in-depth analysis of financials, of tech, of business, and then preparing recommendations for the syndicate, whether the company is legit and whether there are any risks and what is the investment rationale, right, for participating in this deal. And then all the other investors, they review the findings, they provide some insights because they are also welcome to ask the questions and make sure that their perspective is included into the evaluation. And then they make the decision. And very quickly, just to finalize, because I have 1 more minute, I will show how we do that. So what we do in our case in iClub, we are very lucky because we have a fund, TE Ventures, and the fund, they go like in the first phase, right? So they find the deals and they identify high potential investment opportunities in the market, in different markets. So that's why they are analyzing like thousands of deals per year, so that they can present dozens of deals to our syndicate. They perform the due diligence. They are actually responsible for that, gathering all the information, analyzing it, and preparing the company. They are negotiating the terms, making sure that the valuation is fair, and whether it's like mutually beneficial for all the investors participating. And then we, as iClub, we present the deal to our investors in the application. As I said, we prepare a data room there. So then we gather questions from the investors. We arrange a deep dive poll, as it was described today. So we have this session, which is moderated by iClub, and we ask all the questions, and we have the opportunity to get all the insights we need from founders to discover deal even more. Then we share all this information with investors. We always have follow-up questions because it's just 1 hour of deep dive is not enough, is never enough. So we get all the follow-up questions during the next week. and then we respond to them. We provide all the information on materials, for example, financials or additional documents. And then when we have provided everything, investors are ready to make their decision. And then we close the deal and we sign all the documents and make all the transactions. So this is how the process works with us. As you see, basically like following all the best practices. So thank you for your time. I hope that was helpful. We'll be sharing this deck with you so that you actually use all the questions and add yours as well. But I think that's very good kind of basis for you to start this process, especially if you haven't done due diligence before. It might be overwhelming, but trust me, it's very interesting process. I love it myself, so it's very interesting. It's kind of being a detective yourself, right? Yeah, so, and if you are interested to learn more about iClub, you're welcome to join us and download the app and try our product and see how data room can actually look like. Thank you very much for your time. Thank you.
That's brilliant, Anna. Thank you so much. And great to see that you get a kick out of doing due diligence like a detective going in to find out some information. Well, definitely your presentation has prompted a few questions from the audience. I might just ask you one of them, which is kind of an interesting question here, I think. It's quite a long question, but it's about your thoughts to over focus sometimes on charismatic founders. So they might come across as likable and trustworthy initially, but often fail to deliver, and maybe sometimes you kind of miss the less charismatic. So what's iClub's ability to spot the fraudsters amongst the legitimate kind of companies here?
Yeah, so it's very important. You're just saying some words, and I remember some feedbacks from some investors. It's really so. Some founders, they could be like that, and it's important to kind of switch off emotions a bit, right, and go to the questions and ask questions and follow up. And like trust, it's important to trust, but follow up on that, right? So, okay, you say that, but can you just prove that? Can you give me some actual data, actual documents that could prove that? And I think that there is nothing bad in that, right? Being more, more precise. And so even if you come up as an investor who is, asking too much question, I think it's better to be an investor who is asking too much questions than an investor who is making the decision just based on emotions, and then in a couple of years not satisfied with the portfolio, because something is not going well. So I believe it's like keeping emotions to yourself, because I have it sometimes myself. Yes, I like, for example, the founders. I like how they present. I hear and I like what I hear, but then I sit down, and okay, that was nice, but let's go into details, right? Let's go in details. Let's see whether the details match. Let's see whether, everything is aligned, or, okay, here we see that something was said, but not done, and of course, I always still bet on the founders that they overperform, right? So they talk little, but then they come back and bring you a quarterly report that is just make you smile and make you happy as an investor, because oh my God, they promised like that, and now we have like 200% surplus, so we are happy, all of us. Yeah, I think that emotions should be involved, because if you don't like the founder, that's a trigger, that's a red flag. If you don't like something about the founder, it's important.
Exactly. And like a charismatic founder, that's not necessarily a negative thing, but I think you look for confidence, but not cocky, not overly.
Oh, absolutely.
And there are some sectors where a charismatic founder is a real benefit if it's
enterprise. Enterprise. You can't sell to enterprise if you're not charismatic and strong.
Exactly, and it's different people at different stages. If you move in a sales process beyond the initial pitch to the technical aspect, you need people that can speak on a technical level at that point, and that doesn't necessarily need to be charismatic. But it's a big question. We could talk forever about the team and the founders, but Yeah, it's a great question. There's lots of great questions coming in actually, so we could stay here. We could stay here just answering questions. We need to move on, Anna, unfortunately. But thank you so much for a really interesting
Thank you.
a really interesting presentation, and we look forward to seeing you again in the future.
Thank you. Likewise. Bye-bye.
Exactly. Great. Okay, so we're going to just change things up a little bit here now. So I see Sasha coming on. Good morning, Sasha. We're going to have a panel discussion. So with some experienced angel investors and past founders, and we're going to talk a little bit more about everything that we've been discussing here this morning. And we're going to deep dive a little bit more into due diligence and decision making, and what we actually, what people are doing in different ways to make those decisions, and really get under the hood of the car and look at the components of that engine and decide, is this an opportunity for us to invest in? So we put together, and I think is a really outstanding panel this morning. We've got the managing partner, Ivan, a managing partner of the Angel One Fund. Good morning, Ivan. And we have Yuri from iClub Global, so the same organization as Anna, who's just presented. Good morning, Yuri. Thank you so much for joining. And we have Sasha as well, who's a general partner, the GP at the United Angels Network. So good morning, Sasha. Thank you so much for joining, guys. So we might just kick off with yourself, Yuri, and just give a little bit of background to yourself and to iClub, and just to kind of set the scene for what you guys do in iClub.
Yeah. So my name is Yuri Romanyuka. I'm the person that first time stepped in these shoes in 2011. It was I think almost 15 years ago. But anyhow, it's clear that it was the right decision, because for this period of time, I make a chance to explore different options with a startup or investing. From the sales perspective, I was involved in family office that was refused to invest on early stage in Ajax Security when it was just a pre-seed stage company. Right now, it's already Ukrainian unicorn company. So this kind of experience I have as well. Right now, I'm manager partner of the iClub. The secret flavor about the iClub is that we are co-investing with the fund TA Ventures. This fund is also structured in 2011. I know the GP Victoria pretty well. She is a female founder that lead the whole industry further come with great performance results. She co-invests with different investors across globe in US, Europe, Asia, Middle East, more than 230 companies, and made 83 exits. So that's robust about the TA Ventures. And about the iClub, we are already on the market for the 5 years. For now, we already established over than 80 companies in our portfolio, precisely 86 companies count with the last deal that we have this month. And we managed to make 9 exits and made 15 million, a bit more, 50 million euro in returns to our syndicate investors. So that's a high level overview about us.
Excellent, great stuff. So Sasha, you might come in next. Just tell us a little bit about the UAN syndicate, please, and yourself.
Larry, sure, Larry, thank you so much for the invitation, and a few words about personal background. I've started as a founder of a startup company in 2015, and I really didn't know I'm actually starting a startup until an exit in 2019, and a few conversations afterwards when one of Ukrainian prominent investors, Nick Bilagorsky, mentioned that probably my background in B2B SaaS products and how to grow them could be an important thing for me to do my future investments. And this is the first time I thought about an opportunity on investing, but I didn't do anything actively until the invasion that has started in 2022. And then while being a part of the actual startup school, where I usually do more of the mentoring part, I saw my first project that I wanted to invest in, and I'll definitely highlight some of the things what made me think so. And long story short, 2 years later, I have a portfolio of approximately 15 companies I have personally invested into, and also started co-started an angel club and a syndicate a year ago together with Ivan Petrosevich, United Angels Network, that we are doing on a constant basis. And this is kind of different activities, actually, doing the personal investments, which are more for fun. And I definitely want to highlight a bit this, and actually managing a syndicate, which means a lot of responsibilities and stuff.
Excellent, Sasha. That's very interesting. Thanks very much. And Ivan, you might give a little bit of background to yourself and to your One Venture Fund as well, please.
Yes. Hello, Larry. Hello, everyone, and thank you for inviting me here. So my name is Ivan Petranko, and I'm managing partner of Angel One Venture Fund. And Angel One is the first venture fund as a part of university in Eastern Europe. We're part of Ukrainian Catholic University, private university, leading Ukrainian university. We've been active for about a year and a half, and we're investing in Ukrainian startup founders from all over the world, mostly at late pre-seed and early seed stages, and that's how we support them. So we're not focusing strictly on the university spin-offs, but on Ukrainian startup founders in general.
Okay, good stuff. Good stuff. Thanks very much, guys, for that. So look, the focus here this morning is on after a company has pitched to you. So the first kind of 5-minute, 10-minute pitch has gone well. We're pretty happy with what we've seen. We think there may be a good fit between this company and our organization. So what I wanted to talk to you about, what's your process after that? So what are you looking for in your deep dive? So after the pitch, Yuri, you might just put a bit of color around that. So after the pitch, what is it that you're looking for, and what's the process that you run companies through?
Yeah, so when the pitch was already happening through our network, of course, it's plenty of questions that we have still yet open from our investors that need to be covered. And the logic is the following: if the company or founders explain everything clearly and don't have any kind of questions about his company and about his model, probably it doesn't seem to be interesting for our community. That's for sure. If the community has some investors, questions, etc., then it's a different reality. But we always, if we're talking about the still like this kind of due diligence process, we are still trying to align our investor community to the point that they should always treat this startup or founder as a business case, because the thing is the following: we are showing them the founders that have previously exit scenarios, they have traction results from industry, they know how to build proper things in this specific area. So the thing is the following: it's a question to our investors whether or not they will take this opportunity to investigate more than just the pitch from the perspective of the company. Maybe they want to understand a bit more how these new business models is properly can be facilitated in a way that this founder is explaining, or how this model can scale up for the com with quite clear circumstances that they will probably face. So all of that, it's a business case. And in my opinion, the beauty about this scenario that you are, as a part of angel investors community, you are getting always as executive MBA case studies. Every month we show in 3 companies, so you have a chance to explore different industry, different founders, different topics, just to explore all of the opportunities around that you have always. That's
Yeah, and Sasha, we might kind of move on from Yuri. Thanks, Ravi. We might move on to that, and the difficulty, that the challenge that is there for syndicates to do due diligence on a wide range of companies. Okay, so and this is the kind of power of the syndicate as well, right? So not everybody's going to know everything about every company, but you might have someone in there that is able to actually say, actually, guys, I know this market. This is how this product works. So talk to me about the power of the syndicate and how you guys use the syndicate to make those decisions, whether to move forward with a company after the pitch or not.
Oh yeah, that's a very good question on actually making the decision with the syndicate. And usually this is, again, quite an interesting perspective to gather this information from other parties that can be involved to understand better the industry. And what we try to do is take those teams to present at our syndicate events that are already understandable to most of the audience. Something that is more or less usual on the streets with our technology backgrounds, or rather something somebody from the herd actually knows about and can comment upon. And how we do this right now is by obviously previewing the teams before the actual pitch events, and we would take at least half an hour call with the team to understand the background, to kind of go through what they do, and how I usually call this. If an investor can make a call about investing or not investing, there is one main slide to actually highlight, which is the traction, understanding about where is this going, where from, and where to. And again, having somebody in the herd that understands this, we are not trying to get on these complex cases. We're definitely not investing into any kind of blockchain opportunities, as an example, right? Something that we usually understand within the background, and we try also to get the expertise not only from the syndicate members, but from our networks who might be outside of the syndicate to actually comment on those projects. And for the syndicate itself, we present only those opportunities who we as a syndicate leaders understand and would like to be part of. And this is our own personal commitment that we definitely are going to invest in this project because of these next factors. And this is something that is given understanding, a signal to all our community that yes, these folks, this team, this company is definitely worth considering.
Mm-hmm. Yeah, absolutely. So it's about good selection and good screening of companies, and making sure there's good alignment between your syndicate and what you're looking for, and moving on towards due diligence is obviously a bit easier. And that's a good point as well, that you'll often go outside of your network. You'll use the network beyond the syndicate to ask questions and to bring in and help with some due diligence. So Ivan, there's a lot of questions actually popping up in the Q&A. So I'm going to hit you with one of these questions here. So this is quite a long question, but to summarize it, so what are the three main questions you would ask? And without answers, if you don't get answers to these questions, you would not invest. So what are your three main questions after the pitch that are key to your due diligence? Sorry for putting you on the spot now this morning.
Yeah, okay, no problem. Well, obviously, always after the pitch, there are a lot of questions. So there's, no situations that we listen to the pitch and we say, okay, everything's clear, we don't have any questions. Obviously, we do have a lot of questions. Most of the time, we take a day or two to form a set of questions, and then we just throw it at the team, and we want them to be fast, obviously, and we want them to be creative with their answers. So basically, I don't know if I can, just have three main questions, because it depends case by case, right? It depends what kind of team is that, what stage are they on? How well do they know the product, how innovative it is, or are we talking about an already mature market and there is some small niche? So I wouldn't go as far as say there are only three main questions. Every question is the main one and can be the key decision maker. Obviously, we want always the founders to know the market, right? How well they know the market, how well they know the competition. And it's always a red flag for us when they say, hey, we're better than competition. There is no competition. Right. So we want to know, okay, there is someone obviously in your sphere, in your market, and obviously they're somehow fulfilling the needs. So how are they doing that? How are they better than you? And then how will you, with your product or service, will become better than your competition? That's one thing we ask. The second thing we ask, and that's what I'm learning from my LPs, who are mostly from the United States, they always want to play a long-term game, and they always ask a question about the vision. So they want the founders to have a strong 1 year, 3 year, 5 year vision. And again, we've talked here, you talked about change of plans. They will always change. Nothing, nothing works as planned before. But obviously, all the members of the investment committee, they want to know how strong is the vision of the founder or the founding team, and how they see the development of the product, of the team, of the market in terms of 3-5 year period of time. and the financial projections. Again, this will most of the time not work. But again, just to understand what's the vision of the founders, I'd say these three focuses: the market, the financials, and the vision are the ones that we pay a lot of attention to. But again, these are not three most important. These are just few of all the rest.
The answer is there are no three, but there's lots of
and the very important thing that I would note here is, again, how open are the founding team to answering the questions that we throw them at, because usually a lot of the teams, they just drop off after the first pitch, and when they get these 10 or 20 questions and they say, hey, we don't have time because we have to do the product. I mean, everyone needs to do that.
Yeah, absolutely. And that's a key point, actually. And the deep dive sessions and due diligence is all about that. It's not necessarily have they got the right answer, but it's how they answer the question that comes to them. Yuri, I see you've got your hand up there.
I definitely want to point out one hint that probably will work not just for will not work for early stage like pre-seed only, but most of the time seed and Series A and later stage rounds. But what I would like to suggest is to check the co-investors as well, and specifically tied your logic regarding the lead investors. Try to understand what is their traction perspective and who they are. Just to, I remember, Larry, we highlighted this topic at the first session when we just started out this program, but anyhow, I want to also emphasize that if you remember, the company called Doodle was acquired by Google eventually, like it was the one of the first exits that we've seen from the Ukrainian startup. But the lead investor of this company, it was the fund that was initial investor of the Android platform that also eventually was acquired by Google, Anthem Ventures. So that's precisely give you also some perspective who these kind of lead investors, which kind of metrics for success track they have. Does it they perform well with this specific industry pillar? Are they familiar with this kind of project and you used to know how exactly to treat them? Because if this kind of lead is just coming with completely different background and just try to step in with this play at the first time chance, that will be probably also the risk factor that you don't want to mitigate with your own money and, of course, time and involvement.
That's a really great point, Yuri. Thanks for bringing it up. So it's the due diligence isn't just focus on the company, it's focus on the complete opportunity. So you're looking at other investors that are coming in and what's their track record. That's a really, especially if you're not the lead investor, right? You need to see what is their track record and ability to pick winners in this. Sasha, you want to come in?
And I also would just want to mention that it's very important again to not being easy about any kind of tight relation with Russia. If the funds or partners have investments or, I don't know, partners from Russia, it should be a notice for any syndicate or angel investors to investigate what is the risk factors here. Because again, we are early stage investors. We're not investing in public companies, so we don't have SciSec to explore that for us. We need to be secure in this direction as well, because no one wants to be in a station when they put their own money to this bright idea with a great founders, with a great performance, but with fund or investors that has relations with the like sanction list individuals or something else like that will be crazy.
Of course, absolutely. Sasha, you want to come in there?
Yeah, I think what you just suggested about leading the lead investor is super important to highlight, especially for Ukrainian community. For instance, as United Angels Network, as a syndicate, and also as our club members, we only invest in Ukrainian startups. And the reality in Ukraine is that even if institutional investor, VC, any kind of fund would actually enter the deal, there is high probability that will be allocation that is left after this happening, which means that you can kind of borrow the mind of a person with or a fund or a herd of people that actually already did the due diligence and also would come into the round as an angel investor or as a syndicate. And this is a super important thing that is also happening within us. And this is what I was mentioning as actually referencing to external networks, which means that with Ivan, we are on a constant contact. And if there are specific teams that he has already invested with his fund, we definitely understand that if there is an allocation left, there is a potential opportunity for a syndicate. And this is something that allows us to be much more confident about what we are doing from the perspective that our syndicate, it doesn't have 8 years of our history compared to Yuri's, but just about a year ago we have started. So it means we need to also improve our bets.
Absolutely. Ivan, there's another very good question after coming in from the Q&A. I'm going to ask you this question. And this is about after the investment has happened. How do you then collaborate with the startup after that? So we spoke a lot in the first workshop in particular, and some in the second workshop about the benefits of angel investors to companies at the early stage. So do you want to talk a little bit about the value that you guys bring to companies after you have invested in them?
Yeah, thank you. Well, again, that's a both-way game, right? Because what we want from the startup, obviously, we want to help the startup as much as we can, not just with the money. Because the money's gone, right? Then now we want we want to see how the startup progresses, how they make progress, how they evolve. And obviously, for that, we have to see the numbers. So what we do is we ask the startup to provide us with updates. And then we try to decide on what's the best way to do that. Either we get monthly update or quarterly update, just to see how that goes. And that's when we start to talk with the startup. Do they have their own updates? And we're okay with that. Or if they don't, we provide them with our own template, and we ask them to stick with that template. It doesn't always work with our template because some startups, especially if they had previous rounds and they had a lead investor, they have already some templates or frameworks that we have to stick to, and we're okay with that. So what we want to see is we want to see how they progress, and we want to have what we try to do is we do monthly calls with them where we, like in some of the movies or serials, where we see how can we help you. So we want to know where the startup is and whether we can help them with anything, either finding an expert from a new market or, with someone they cannot get their hands on because of our network, mostly in the United States. And that's how we want to be helpful. So we try to find the best match for the startup. If we don't have an exact person or someone that we can help them with, we can, give a call to some of our friends, to other funds, like Sasha's fund or someone else who has either another expertise or another network, and then we try to find someone that we can match and provide our startup with. So basically, just keeping that contact, monthly contact, makes us, well, first of all, that's about updates, and another thing is about building the trust. Because if you talk to startup once, let's say for 6 months, most probably you don't feel the founding team and you don't know what they live with and what stage they're at. But if you have these monthly update calls, most of the time you build that trust between you and the founding team. And then your monthly updates are not just about the numbers, but it's about what does the startup do, what is their vision, what are they thinking about. And then it's more like a friendly conversation and more about the insights that you get, and then you can build that, not just trust, but all the communication and partnership with the startup.
That's such a good answer, Ivan. Thank you so much. And it is true, and we see it in the syndicate that we run. Especially because we're kind of pre-seed and seed stage investors. Very often you have to coach the startup on how to communicate with the syndicate after. It's not something they've done before, or it's not something they've been trained to do. So there is a bit of coaching on that. Yuri, anything, just final thoughts? We have a quick couple of minutes left here. Final thoughts on that, the value that you bring after you've made your investment decision.
Yeah, to be honest, I think that just maybe highlight that Sasha and Ivan, they are doing an amazing job investing a lot with new tech startups that they right now sourcing, and some of the companies already perform great results, especially with the latest updates from the Web Summit. So guys, hopefully we'll probably also change and adjust our strategy to also invest in new tech. But you guys are doing a proper job. And just to maybe also give you a hint about some perspective, like the question also to angel investors, specifically syndicate member, whether or not they're willing to invest their time. Because just to give you an example, when I joined the iClub as the manager partner, it was just 45 companies inside the portfolio, but we spent, I think, around 3 working weeks just to create all of the reports for our community of investors. It was crazy a lot and pretty difficult. So right now we have 85 companies, and we automate all this flow and everything done precisely in just 1 day, with also like human involvement to check everything that it's done running properly, and we already have it on the platform. So my point is, if you want to thinking about your portfolio manager, also think about your involvement and what your resources. Do you have any kind of limitation about that? Because again, if you want to help your startup community or startup portfolio, it will take your resource. If you want to just be observer, try to also involve some tools that you have on the market. You can easily research them to estimate your portfolio size, the value of your portfolio, DPI, TVPI, all of that has already been automated. And you will be familiar about how exactly you should treat your portfolio with specific investors. That's it.
Perfect. Cool. Yuri, thanks so much. Sasha, I'll give you the last word before we finish up.
And I just wanted to drift a bit from the understanding of the actual syndicates rather into the personal stories, because it's so important to highlight, like probably people here on the call would also want to understand what to do if they are personally engaged with a startup and either they do or do not invest, and probably there is no time and there is no possibility to get in touch with all the syndicates and venture clubs. So from the red or green perspective things, I would want to highlight reacting and coachability as definitely a green flag that we need to find in the startup. Respect between the parties. Definitely don't invest in somebody you don't trust, or somebody that wouldn't trust you. Understanding of the background of the person you would work with, and obviously the growth opportunity. And it's very important to say why people would want to invest as a person, not as a syndicate, not for the bigger opportunity, not compared to the global market, because you can invest in stocks of high growth companies. But like, why do you want to invest personally in, for instance, startup from Ukraine, somebody from your network? This is mainly because you want to be part of the story, because it's a betting, something that is like a casino, but with a great value for the person you are betting on. It's potentially a growing market that you need to observe. And also, don't forget to look for the attraction. And there is one thing that makes the most sense for this personal investing. This is bragging among your friends when you're doing the barbecue that you're part of this great story, somebody that is growing tremendously, or somebody that is trying to grow, and you're basically trying to make this person more successful with your advice, with your money, and just again being part of the story. Thank you.
That's it. Look, thanks for finishing that, Sasha. Yuri, Sasha, and Ivan, thank you so much. We could have stayed chatting for an awful lot longer, but I'm just going to finish up and hand you over to Clara, who's going to just introduce a little bit about demo days, etc. Thanks, guys.
Thank you so much, Yuri, Ivan, and Sasha, and Larry for chairing this panel. This is a great session and all these pro tips and expertises that you were able to share today. Thank you. So we're going to have a little break very soon, but just before that, I would like to share with you that we will be having a demo day. So I'd like to invite you to register to the next demo days where Ukrainian startups will be pitching their deep tech innovation solutions as investment opportunities for you. So all these are going to be running online, and the upcoming demo days are displayed here, and the registration link can be found in the chat box. So we'll leave it up for you whilst we have a little break. We'll be coming back now in a couple of minutes. Let me just see exactly. So 10:30 CET time. I'll see you in a bit. Hello again, everyone. I know this is a bit of a short break, but I hope you got to stretch your legs a little bit. And you can come back wide awake for our next session. There's a lot still to come. So, Abby, can you change the slide? Yeah, that's perfect. Thank you. Now we're going to have we covered so much until now. We covered what happens immediately after the pitch, the deep dive session and due diligence, and how those are important factors to lead the investors to a well-informed decision. But our next guest speaker is Michael Bambrick, and he's a legal advisor to entrepreneurs and investors who are building, funding, and selling businesses. And Michael will talk about the process of making the investment and the investment documents that are needed to finalize the investment smoothly. So this is the part that the founders are most looking forward to, I think, in actually closing the deal. So Michael, are you on now?
I am indeed. Hi, Clara.
Oh, hi, how are you? And good to see you. And you have full control then of the panel, of the screen, right? Okay, perfect.
Right, thanks. And so we can start on the next one, Abby. So just as a brief overview then, I know you've kind of spent the morning talking about angel investing. I'll just touch on a kind of a brief introduction to it and how it compares to venture capital, which is the next step. We'll touch on some of the key investment terms, the transaction process overview, so how you get from a term sheet to actually having cash in the bank, and then some post-investment engagements. So I suppose how you engage after the deal is done. And if we've any questions, then I think they'll be collected in the chat and we can answer them afterwards. Next, please. Thanks. So in terms of angel investing then and its role in early stage funding, it's absolutely crucial for very early stage startups. It's very difficult to find the first 100,000, 200,000, really up to the first million. There aren't as many funding options until you start raising around $1 million plus. So angels are really key for helping early stage startups to get off the ground, to get their MVP, to get the really first signs of life, first customers, all the rest. Some of the differences then between angel and venture capital: angel tends to come in earlier than venture capital. It tends to be friendlier terms for founders. It tends to be a more personal relationship. It tends to be longer term, or it's called patient capital. So they know that the exit is going to take a little bit longer. They know it's a little bit riskier because they're coming in at an earlier stage rather than the VC funds who come in later on when the company's a bit more mature. Next, thank you. So the key terms then that you're looking out for when either investing or raising money are on the slide here, and we're going to go through them just in high level. You can get into a lot of detail. There are lots of different variations of these, but just so you know what to expect or what to look for. So there are really two structures that we'd see most often when you're raising money. Either it's issuing shares, so it's actually an equity round, or it's too early to have a valuation. And so you need to use something else like a loan or a safe. If it's an equity round, which means you do have a valuation and then you know how much it is per share, what the price per share is, you need to have an understanding, I suppose, of the various intricacies of valuations and what you're actually receiving in exchange. So how much of the company are you going to own? What type of shares are you going to receive? Because the different share classes can have different rights. Some can be voting, others not. Some have a preference in terms of who gets the money and when they get it. These are really material terms that you need to understand. You also need to understand that when you own shares in the company, additional shares are going to be issued over time. So whether that's funding rounds or there's an employee share option plan or maybe some venture debt, which would issue some warrants, all of these are going to dilute your position. If you're the founder, it means you're going to own less and less of the company over time. If you're an angel investor, it means maybe you started out when you closed your investment, you owned 10%. Maybe when the next round closes, you might own 5%. And I think the key thing to understand here is that even though you're going to end up with a smaller share of the company over time, the company's value should be growing all the time. So you have a smaller piece of a bigger pie. And you're not really looking to protect against dilution fully, as in you can never be diluted. That's just not something that's ever agreed. But you just need to understand that over time it's going to happen, and you'll be part of the round. You'll understand what the terms are that are coming in on. If you're the angel investor, you'll often have a right to participate in the follow-on rounds as well. Usually angels don't, but if you believe in it, if you have money to go again, that's usually something that you can do. If there isn't a valuation, which at pre-seed and seed, often there isn't, because it's just very difficult to agree a valuation with investors. It's usually too early in the journey in terms of the product, the customers, and just the life cycle generally. But you can still raise money. So you use convertible loan notes or safes. People might know safes from Y Combinator, which is one of the most famous, if not the most famous accelerator in the US. And the idea is behind these instruments, we'll give you the money now as investors and you give us the shares later. And the idea is that there will be another funding round, probably seed or the Series A round, where a venture capital fund comes in. They will do heavy due diligence. You'll also be at a later stage in any event. And all of these will enable a valuation to be determined. If you come in on a safe or a loan note, you're probably going to get something like a discount or maybe a cap, but the discount is the most common. And to put it simply, if the VC comes in at the later round and pays €10 per share, then the angel investor holding the loan note or the safe will have let's say 20% discount. So instead of paying €10 per share, they'll pay €8 per share. If you're the angel investor, this compensates you for coming in at an earlier stage, for taking that gamble when it was a little bit riskier, and for believing in the company. So you get more bang for your money, essentially. If you're the company trying to raise the money, obviously it's a great way that you can go out and entice people to invest without having to have the valuation. So you don't need to wait until you get to that later stage. It is possible to raise money much earlier. And these are commonly understood instruments as well. So, it's usually an easier sell for the company to explain when there's so much literature out there on these now. The valuation then, so it's really important, and this is if you're raising an equity round, it's really important to understand whether you're investing at a pre-money or a post-money. Really the difference is, with the pre-money, let's say you're saying the company is worth 8 million before the investment money comes into the company. Let's say you raised 2 million, 8 plus 2 is 10. So your post-money valuation is 10 million. It really impacts on your equity stake. If you're the investor, you need to know which it is, if it's pre-money or post-money, and you need to know whether the employee share option plan is coming in before you or after. It's almost always before if you're the investor, because you don't want to be diluted by it. Preferred shares then, when you set up a company, you'll usually have ordinary shares or ordinary stock, as it's called in the US or some other jurisdictions. When the investors come in, then they'll usually have a preferred share class, and that's because they'll have slightly better rights because of the amount of money that they're investing. If you're coming in as an angel investor, really early, and you're coming in for equity, it's most likely going to be ordinary shares as well. It's usually designed as a round to be very simple, very quick and very cost effective. If you invest as part of a syndicate, however, you start getting into maybe, bigger funding rounds. So instead of one angel investor putting in 100,000, you might have 10 who put in 1 million, and someone putting in 1 million gets more rights. And you should understand that as a founder as well, that you should expect, much lighter documents and fewer rights for the investor. If the check size is smaller, if it starts getting into bigger money, you need to expect, I won't say heavier terms, but a little more complicated terms. Investors will need more protections, and they'll have basically paid and kind of earned by paying better rights. With preferred shares, then the main one to look out for is called liquidation preference. This is really to protect the investor's return. There are two different types. The first one is known as a downside protection. It means when you sell the company, the investors can choose between getting the amount that they invested back or the percentage of the company that they own. So let's say, for example, the company is sold and they own 10% of the company, and based on that, they would have 800,000 euro returned to them for their investment. But if they invested 1 million to begin with, they can choose to take 1 million out of the pot instead of the 800,000. The other one, it's called a participating liquidation preference. I don't want to get into too much technicalities today, but the difference is they'll be able to get their 1 million out first, and they'll also get to participate with their 10%. So that really changes things for the founder and the return that they'll get. This is one of the most important terms to look out for, and it's sometimes led to founders selling companies for quite substantial sums, but because there are so many investors with so many of these preference shares, one on top of the other, they might actually walk away with not that much money. So just really watch out for that one. Anti-dilution protection then. So this is to protect investors where they think maybe the valuation that they've agreed is a little bit too high. They might agree the valuation that you want, that you've convinced them to come in on, but they'll say, well, look, if you raise money at a lower valuation after this, then we're going to change the price of our valuation. So with full ratchet, it means, if they pay 10 euro and the next round, which will be a down round, is 8, you'll change their share price to 8 as well, and they'll end up having far more shares. With the weighted average provisions, it's not as heavy on the founders in terms of dilution. There's a calculation done between the number of shares issued in the last round and this one, and the two valuations. It's more founder friendly, and it's the one that we'd often, almost always, you could say, see because of that. In terms of rights and protections, then you have to remember that companies are basically majority rules. So it's the majority of shareholder rules, and at the board level, it's the majority of the directors rule. For that reason, then you need to have shareholders agreements, and the angel investors or the funds will have various protections, basically how they manage their investment. Again, they're putting in, sometimes substantial amounts of money. If it's an angel, it's their own money. Obviously, it's very personal to them. They want to see it do well. If it's a fund, they've taken in money from other investors, and they need to explain their investments and actions and their portfolio companies to their own investors. So the way they'll do this is usually by having a board seat. Typically not if there's, an angel coming in individually. Board seat's usually something that comes later on. If you've got a syndicate of angels, again, if they're putting in 1 million plus, we'd certainly see board seats. We'd see information rights, which is, management accounts, annual accounts, just regular updates on the business. They'll use those to report to their own investors, but also just to manage the portfolio. And particularly, angels who invest very regularly, or funds who obviously invest professionally, they might have seen issues before in other portfolio companies, and using the information you give them, they might see it coming down the tracks. So some founders worry, I can't give away all of this information to all of these people. It's very confidential. It could be taken and used to compete with us. That's not at all the case. It's really just so people can monitor their investments, and so they can usually jump in earlier because they've seen this before. They can either put you in touch with someone who can help. Maybe they can do it themselves. They can help you with a key hire. There are various different reasons for it. The final one then is vetoes. There will usually be a list in the document, in the shareholders agreement, maybe 30 or 40 different actions, all strategic, and that's to mean they're not day to day. They shouldn't be hindering you, but you'll need the investors' consent. Again, smaller angel rounds, this is probably, it isn't a factor. It's so early, it's kind of not really worth having in any event. If you get to, angel syndicates and VCs, it is something that comes in. There's more money involved. The company's probably at a later stage, but effectively it will be things like, you can't issue shares without their consent, which would dilute them. You can't change the rights attaching to their shares. Sometimes you can't sell the company. Again, they don't want you to sell it out too soon, because they've modeled their investment and the return they're looking for. These are things that will be negotiated at the term sheet stage. So basically all of these key investment terms, these are the high level ones that you'll discuss, with a 1 or 2 page term sheet before you get into complex legal documents. Because if you're not able to agree on these, you're probably not going to be able to agree on longer form documents in any event. I'd say, term sheet stage is definitely the point at which you should get advisors involved. Whether that's legal or tax or accounting, definitely other founders as well, people who've been where you've been. I'd ask them for recommendations as well for your professional advisors. It's good to get them in, the professional advisors, kind of early if you can. You want to make sure you've got somebody who knows exactly what they're doing, who's done this repeatedly. They know what the terms are, they understand the transaction process, they can guide you through it, they can tell you what's reasonable, what's not. It will save you a lot of time. And if you deal with people who really don't know what they're doing, it can actually risk the deal, because you might seem, like you don't know what you're doing, or you're unreasonable, or, there are various other issues that can be solved quite easily just by having the right people involved. And definitely, working, if you're an angel investor, contacting others, seeing what they've done, how it's worked, running a few questions by them, it can cut through things very quickly, and likewise as a founder. Next, please, Abby. Thanks. In terms of the transaction process then, so getting from the term sheet to having money in the bank, whether you're the founder or you want to close it as the angel investor, once you've signed the term sheet, then due diligence would probably have started a little bit at the early stages as well of the discussions. But now, once the term sheet is signed, investors usually start digging in to make sure that what they've been told is actually, correct, whether that's looking at the financials, looking at the intellectual property. They'll meet the team, they'll want to, chat to everybody about their background, their history, where they're going. It's also to understand, can you actually commit to this full time? What other obligations do you have? Are you going to stick with it for the longer term? And of course, the market potential as well. When it's at a very early stage, pre-seed or seed, due diligence is usually a fairly quick process, because the documentation that's in place already is usually very light. There are probably very few shareholders. It might just be the founders. The IP is at an early stage. The team is quite young. It's when you can start getting to maybe around Series A, which could be angels as well as a syndicate, maybe putting in 1 to 5 million. They'll dig into the due diligence in much heavier detail, and there'll just be far more to go through, because the company is at a more advanced stage and has been around for a longer time. In terms of negotiating the term sheet, then we've just discussed the key terms to focus on. In terms of the process, then, if you're looking at 1 or 2 angels, I'd say kind of sub 500,000. Or you might have various angels at 25,000 each, all coming in individually. It's really the company and the founders who need to drive that process. So often you might be dealing, I'd say more often than not, with angels who this might be their first deal, or might be their first 5 or so deals. So they're really still getting to grips with it. Other angels do this all the time. They'll know exactly what's required, what the process is. But more often than not, you will need to drive the process. So you'll work with your, let's say, lawyer to prepare the term sheet. You will then be able to go and discuss it with the angels. You'll be able to guide them through the process, because again, they're probably running businesses or doing something else. It might not be a day-to-day focus for them. If you can get them to sign the term sheet, then you're probably going to have your lawyers draft the documents. They should be pretty light. I'd say start with something very pragmatic and reasonable. There's no point being one-sided. You'll either turn people off, or you just drag out the negotiations for much longer than you want to. So I'd say just start very reasonable. Again, work with someone who knows what that means. You'll basically have to run the process then as the founder to bring in all of the angels, get them all to agree. If it's a syndicate, or if it's much larger investment, the syndicate is probably going to run this process. They'll probably give you the term sheet, which you'll review with your advisor, and they'll probably issue the documents to you. Again, they'll be longer form, they'll be more detailed, because there's more money involved. Closing the deal then. So the typical steps are, once the term sheet is signed, you're into due diligence, and at the same time, the documents are being drafted. So let's just say it's a smaller round and the company's driving that. Your lawyers will prepare the documents, they'll review them with you, they'll incorporate your feedback into it and then share it with the other side. So with the angels and with their lawyers. Similarly, they'll have a review process on their side. They might look to make a few changes. They might have a few asks. You usually jump on a call then, try get everyone. It's the quickest way. Hammer out whatever is left. They'll send you back the documents, and this might go on a few times. Ideally you'd minimize it to the extent you can, but once you get the documents into agreed form, you start sending them out then to everybody for signatures. So that could be the founders, it could be other investors, anyone who really needs to sign off on the deal, and anyone who's investing in the round. Once you have all of the signatures, then the funds are lined up. That might be put into one lawyer's account and then sent to the company, or it might go directly to the company. It depends on how well people know each other and how many people are involved. If you've got 10 or 15 angels coming in, it's probably going to go into the lawyer's account, one of their lawyers, and then they'll aggregate it all because they can send the money as soon as the documents are signed. In terms of the timeline then, I usually tell people, if you're pre-seed or seed, you need to budget, I would say 4 to 6 weeks between signing the term sheet and having the money in your account. The more people there are involved, it'll take a little bit longer. The fewer, it can be done much quicker. If you're raising 100,000, it should happen very quickly. If you're raising 1 million, it will take a little bit longer because the terms are a little bit more complicated. Next, please. In terms of monitoring and support then, if you're an angel investor or a VC or anyone else really, you want regular updates from the company. You want to know how the investment is doing. You'll have information rights in a shareholders agreement. Again, these documents ideally just go into a drawer when everything is done, and they only come out if you need to actually check something or rely on it, which hopefully it doesn't come to that. Ideally, the company, is sending out maybe a monthly or a quarterly update. There's tech out there now that automates all of this. It's quite simple. Usually it's just, this is what we're going to do next month. And then next month, they'll tell you whether we did that or not, how well we did it, what the issues are, and what our next steps are. Maybe they'll have some asks as well in terms of, this is how you can help us. This is who we need to be put in touch with. Maybe it's an investor, maybe it's a key employee or somebody else. But if you're getting the regular information, usually it helps the company and it also helps the investors as well. And it keeps everyone in the loop. If you put in a material amount of money into a company and never hear from them again, you start kind of getting a little bit agitated. And for the company, that person's probably not going to introduce more of their network to invest in your next round. So just keeping people updated can be really helpful. In terms of exit strategy, then, there are various ways. Obviously, if you're investing into a company, the idea is eventually it will be sold and you'll have a return on the investment, which is hopefully a multiple of it. And if you're the founder, if you're taking in investment, you appreciate that. That's the type of journey you're going on, and you're looking to exit as well and hopefully make a lot of money from it. The usual ways are, and this will probably be a few funding rounds and a few years later, are you're acquired. There's an IPO, so you go public, or there's a redemption if you're the investor. So an acquisition, it might be a private equity fund that buys your company, or it could be another company like yours or in a similar sector that's known as a trade sale. So they might buy you because you offer something that complements them. The IPO then usually comes much later. That's a much later stage, kind of an exit. It's really an investment, but it gives liquidity to people who've invested earlier as well. So it can be seen as an exit. Redemption rights then usually come more at the VC stage, but if an angel or a syndicate is putting in a material amount of money, they might negotiate redemption rights, which basically means, look, if the company hasn't gone where we thought it would in 5 or 6 years, we can ask you to give us the money back, essentially. That's not really where people want to end up, but people who are investing need to have a return at some stage. So it might be something that they look for. And that's it.
Michael, thank you so much for that and for coming on and helping out. So you covered a huge amount of ground there, so really appreciate that. I'm sure there are a number of questions there, but we're just going to move on with the next section, and we have a Q&A piece after the panel discussion later on. So we'll hopefully answer any of the questions in that section. Okay,
Right.
perfect. So we're just going to move on to our next piece. Our next speaker is Ivan Gutabeli. He is the chair of the MedTech Syndicate. And Ivan is he's a previous founder with a successful exit behind him, and he's now chair of one of the biggest syndicates in Ireland. It's called a MedTech Syndicate, and it's one of the largest and most active angel syndicates, investing, as the name would suggest, in deep tech opportunities around the medical device space typically. And we've a good history in Ireland of co-investing between syndicates, and the MedTech would be one of the syndicates that the syndicate we run, called the Bull Syndicate, have a good history of co-investing, and thankfully a good history of some exits as well. So good morning, Ivan. Thank you so much for helping out this morning. And I will just ask you to turn on your camera. I can see you there. Perfect. How are you, Ivan?
Hi, Larry. Good. How are you? Do you hear me well?
I can hear you loud and clear. Thank you so much for jumping on and helping out today. And I'll hand the floor over to yourself.
Thank you, and a pleasure. And thanks for inviting me for this session. I will share my screen. Hopefully
Yeah, absolutely.
it works. Let me just. Do you see it? Do you see the presentation?
Yeah, I can see it there now, Ivan. Perfect.
Brilliant. So, hi, everyone. Thanks for the opportunity to share our experience. So as Larry said, I'm a former founder. Now I'm helping the syndicate, the MedTech Syndicate, since 21. The particular thing is I never raised money on my end. I bootstrapped my company and then exited, but that didn't stop me from learning about the business of raising fund and managing syndicates. So everybody can do it if I can do it. To give you, this slide is not, here you go. To give you a quick understanding of the syndicate, so we started in 2014. We really focused on one thing, medical technology. It was really a club at the beginning, and now we're professionalizing the activities. And you can see the numbers. So we're 60 plus members, and to have 20 companies right now in our portfolio. I'm not going to spend too much time on understanding business angel syndicates because that's been explained for the past previous sessions. It's just that every syndicate might have a different way to work. I think our key point here on our hand is that we really focus on what our members want. And it's really, as I said, focus on the medtech aspect. And we really want to leverage the collective expertise of our members to ensure that we have a better understanding of what we invest in. And of course, trying to share risk and increase also the investment capacity for all our members and the company that then get the funds. So why is it important to do portfolio management and tracking? So there's two aspects. First, we're a syndicate of business angels, so we don't make financial decision for our members. Every members do their own decision in terms of investing. But what we want to make sure is that the syndicate provide all the information that is available for the members to make the best decision. So that's why portfolio management is important. And that helps to make sure that the members have a good visibility on the potential risk. So, as all investors, you want to diversify to reduce exposure to individual investment failures, and having portfolio management and visibility to the data help investors have that visibility. The idea also is to help provide the return optimization opportunity for the members. So what does that mean is you want to balance, so it's all high risk. We're investing in startup, it's all high risk, but you want to balance the short-term horizon risk versus the long-term horizon risk. The benefit of providing a portfolio management is that you can give visibility to our members of when the company would potentially exit. Is it company that will exit in 2-3 years? Is it a company that will exit in 7 to 9 years? Being in the medtech field, we invest early, and we know that it will take time for the technology to be fully vested and tested and clinical trials. So if we invest early, then we know it's going to take some time. But at a certain stage where the syndicate gets enough investment power, you can maybe come at a later stage for some of the companies. And it happens that we've been following companies for a while. We've been waiting for them to show some results, and then that the syndicate join at a later stage, which also allow to expect a shorter period of exits. So that's important to have this portfolio management for this. Of course, it also helps members to allocate their resource. It's important to give visibility to new companies, but also to existing companies, and new members especially are interested to see what existing companies you have in a portfolio, so that they can get first more knowledge of those companies, and once they're confident about the companies and what they're doing, then decide to invest. And that helps efficiently deploy their capital, and also help the group within the expertise on how to decide when to invest. It also helps to engage with the companies and with the members. So as I said, give members visibility for potential future follow-ons. It's very important for existing members, but also for new members who joins, who wants maybe to have the opportunity to invest. It's also important to the members because it gives them visibility on where they have invested. At the early stage, when you start, you will see later on, you might use Excel file, etc. And it's up to each investors to know how much they invest in which companies. But at the end, once you have a level of maturity in the syndicate that is higher, you want to provide that visibility to your members. You want to tell them, okay, this is where you invested and how much. And that helps to make sure that the members are engaged with the syndicate. And of course, asking for quarterly updates, discussing with the companies to make sure that you can, share that information is key for engaging with the companies and keeping in touch with them. And at the end, I think the key point is to build trust. So if you have an active portfolio management process, you will contact the companies all the time. You will make sure you have regular discussion with them. And on the member side, same thing. You will keep them updated. You will engage with them, and all of that build trust on both sides. So it's a key part of your syndicate activities. As I mentioned, when you start a syndicate, it's as I mentioned, we started as a club. I wasn't there at that time, but when we took over some of the syndicate activities, it was all Excel files. So you don't need really to start with the Rolls Royce of processes and systems and platform. When you start to syndicate, what you want is focus on the deal sourcing, focus on the startups and the teams that you want to back with your members. And at that stage, the reporting, the portfolio management is very simple. It's an Excel file, and you want to keep it as light as possible. Is with more and more companies that you invest in as a syndicate, I think that's where you need to get more professionalized and more structured in how you get the information from the companies and what you provide to the members as information. So, originally it's a very transparent, it's always transparent, but it's a very simple process. Whatever information you provide or you've been provided by the company, you provide to the investors. And the more and more you're mature, you can add a layer of information to that. So I'll talk about it in the later stage But you can then look at the overall portfolio, identify which companies at which stage, and in the later stage of maturity, look at potential exit, what type of ratio will you expect, when will that happen. So this will come at a more mature stage for your own syndicates. I think one of the key aspects is to be cost effective. You want to keep your transactional costs reduced for the members. So you don't want to have a quote-unquote factory, very complex system and process that costs a lot. You want to keep it simple and evolve gradually based on the size of your syndicate and the number of company in your portfolio. Okay. So the key components of portfolio management, it's not just about reporting and analysis. It's from the whole start of the process. You first need to identify as a syndicate what are your objectives, what are sectors you want to focus on, and what type of stage you want to invest in. And this is really coming from the members and the interest of the members. And usually you reflect that in some type of syndicate charter. So it's important to have that identified because it will definitely then help the next step of portfolio management. As I mentioned, MedTech syndicate focus on medical technology. So it helps for everything. It helps for focusing on the deal flow. It helps on focusing on what we expect from the company. It helps in the networking also for helping companies. And it helps in the reporting of what we expect and when from the companies and what we can share with the members. So due diligence is part of portfolio management. I don't want to spend too much time on that. You've got good discussion already. Having a thorough evaluation of the potential investment is important. And it's the base where you will then identify how you want to monitor certain companies and different milestones. So monitoring and support, this is where you can have an ongoing oversight and you can assist the companies in the portfolio, and also that you report that information to investors and potential new investors. So I think one important thing to take into consideration is the better you are in portfolio management and monitoring, the better then you'll be able to communicate with your members and share the information, but the better you'll be able to also potentially attract new members. So of course, information is confidential, so you have to make sure what can be shared within the syndicate and outside the syndicate. It's very important. But at the end, it will help you if you need to attract new members. And eventually, once you reach a certain level of maturity, it will help in managing the exits. Of course, the follow-on, so what we call follow-on is investments that are done after your initial investment. It's important to keep that in mind is when you start to invest in a company, especially in very early stage, the company will need funds at a later stage. And then you're left with two decisions. Either as an investor, you want to make sure that you can follow on, or you just say no, I did it once off, and now it's the role of maybe other investor to do that. As a syndicate, you want to give that opportunity of follow on to your members. For existing investors, first because there's preemption rights, and some investor will want to make sure that they have those preemption rights and they can invest to keep their percentage on the cap table as their initial investment was. But also for new investors, that might be if there's room for new investors to come, new members to come, that they're able to join these companies. And then the exit planning is very important. It's not an easy step. It really takes some time and effort. But at the end, you want to recycle the money so that from an exit, you can reinvest in new companies. So if you can give that visibility to your members, then you can also make sure that you can sustain the flow of investment to your to future companies or also existing companies. So it's key. So to develop your investment strategy. As I mentioned, you need to understand which sector you want to focus on, which stage you want to invest. Is it seed, early stage, or growth stage? And then your geographical scope. If you want to stay regional or be more global, I think one of the key aspects again is what do your members want. A lot of the time, there's a lot of local tax incentives, national tax incentives, if you're investing in national companies. So that also decide what your investment strategy should be. And then once you're invested in a company, as I mentioned, you want to make sure you keep that relation going, and you have regular updates, and then you can then give a proper picture of all the companies to all the members. So we do that through regular updates. You want to have established consistent communication channel with the company, which means that for each company, you have a syndicate rep, which is usually the deal lead who helps for the due diligence. That syndicate rep will be the point of contact with the company, will provide the quarterly updates for all your members, for all the investors. And you need to identify that frequency. We do quarterly updates, but maybe your frequency needs to be monthly or others. So you need to identify what your members want and what you can do. One key aspect also is if you have a director or an observer at the board, that helps in terms of communication channels. There's always a conflicting interest between being a director and being a shareholder. So you need to understand that if you bring a director at the board of a startup, because directors have a duty to the company, shareholder have a duty towards the shareholder. So if you have that dual hat, it could be tricky. So in our situation, learning from past experience, we try to, even when we have an observer director at the board, and there's a new follow-on round, for example, we try to have somebody else in the syndicate to manage the round as an investment, or to be the head of the investors, just because the directors again have conflict of interest sometimes with between the director's role and the shareholder roles. So it's an important thing to consider. And the information is not only financials. For us, it's very important that we get regularly updates on the financial, but also in the key inflection points for the company, the key milestones, and you need to understand what those are for your company, but then for your sector. And those milestones, then we capture them on a regular basis to make sure that we identify if progress is made or not, which also help us to identify, do we need to get more involved or not with the company and give more mentorship or more support. It's important because it also identify if the runway will be met, if you need to maybe have a follow-on round earlier than planned, then to give visibility to your members is key. At the end of the year, what we start doing now is to look at all our companies, to ask them, when do you expect to raise? What's your current runway? When do you expect to raise? And then we compile that and give that picture to all our members so that they know and they can prioritize their investment between what do they need, the pocket of money they need to keep for existing portfolio companies versus pocket of money they can spare for new companies that we're going to introduce them during the year. So it's important. And relating to all that is the performance tracking, the KPIs. So again, you need to understand what's important for your members and for your companies. That will depend on the business model and the life cycle stage. Is it pre-revenue, post-revenue? It's important because, as I said, it creates visibility for the next round and the amount to raise. So for us, every quarter we ask, what's your runway? When do you expect to raise and how much? We put that on a quarterly basis to all our reports so that we're constantly aware of the cash need from our company. It's also important to understand the cap table and preemption rights. So when you manage companies, sorry, when you manage portfolio of companies and there's follow-on rounds, you really want to have visibility on preemption rights for each of your members so that you can, again, give them visibility on if they want to keep the same percentage on the cap table, this is the amount of money they need to invest. Again, this is more additional work, but it's added value to the members, and it helps to smooth the process in case of a follow-on round. And at the end, again, that helps to build the trust with the members, with the companies, and to have a good exchange of information. So the way we work at the syndicate, as I mentioned, we have 20 companies. We do quarterly updates that is just after our pitching sessions. We also have weekly or monthly updates that are important, especially when there's a high period of activities, usually at the end of the year, to keep our investors updated on when, how far a follow-on round is gone or a new round is going, which stage it is, when do we need to the money to be wired for the different raise. So it's this type of weekly and monthly update is important. We do have a call to action also for companies, to our members, for companies that are following on with a new round. And every time that we close a round, we make sure that we track what was invested by who, how many shares. And that was previously Excel, but now we moved to a SaaS platform. So again, different level of tools based on your maturity and cost. And the benefit of having a SaaS platform is that now it helps us to do proper portfolio analysis. So we know, what valuation, when, what's the current IRR for each companies, et cetera, et cetera. And our next step on our hand is to plan the exit, not in terms of push for an exit, but to be able to give some visibility to members in terms of range of valuation, range of timing, and again, it's just information to help members to make their own decision. So it's based on your maturity and the level of information you have, you'll be able to do this type of things. Now, what are the key challenges for portfolio management? Well, of course, you can't control what you can't control. So the economic ecosystem changes. For example, we know that the VC money has taken a while to come back in the money cycle. So that required a lot of our companies to come back to us for follow-on rounds. So you need to be able to manage that, and having good portfolio management helps you trying to respond to these problems, these challenges. Resource constraints, again, we're a non-profit organization. We're not a fund. We don't have X% we can pull out of a pile of money that the LP had given us. So we have to make sure that whatever we do is very cost effective and can be done within the budget and money we have. And make sure also that everybody is aligned, which portfolio management help, because then everybody has the same level of information. It helps people to be aligned, but you still need to make sure that all your members share the common goals, that shareholders also are aligned for each companies, which is not always easy between founders and VCs with different timeline of exits and different priorities. So it's important to keep that in mind when you discuss with companies and you try to make sure that the interest of your syndicate are respected without damaging the relation. So best practice really for success, diversification is very important. So even if we are in the medtech sector only, trying not to put all your eggs in the same basket is key. between different sectors within the medtech, different stage of companies. Keeping an active engagement, staying involved with the companies, with the syndicate is very important. It makes sure that syndicates is engaged with the company, but also that you can bring new members, you can attract new companies also, so it's very important. It is a continuous learning, it is a journey. So, it's, as I said, I bootstrap my company. So when I invested first, there's a big learning curve. You learn from your mistake. But at the end, those experiences help you to build, a good process with the syndicate and with your members. So it's important. And you want to be, keeping abreast of industry trends and best practice. Continuous improvements, again, adopt new system, provide better service to companies as well, to your members, based on how your syndicate is growing. It's important. And collaboration is key. We mentioned leveraging expertise from maybe also outside the syndicate, definitely within the syndicate, but also between syndicates. So we work, as Larry mentioned, with Boo. We work with other syndicates in Ireland to make sure that we can share the risks, share the expertise, and at the end, everybody makes better decision and help each other to reach a certain level of success, hopefully. So that's it. I'm not going to spend too much time. Really, the way to make sure portfolio management is working is the result at the end in terms of maximizing return, minimizing risks, and ensuring support for the portfolio company. It is a strategic approach. It requires a bit of discipline, and it will evolve based on the level of maturity of your syndicate. At the beginning, as I said, your club, you want to make things work. You want to focus on the companies, on the deal flow, and bringing the good team, the good startups, and members. And the more your syndicate grow, then the more you need to put discipline and system in place to make sure that you have good portfolio management.
Really great.
That's it.
Thank you so much, Ivan. I really appreciate it. It's very thorough, and even the tips that you gave about understanding well your members, the stages and the sectors that they're interested in investing, the reporting system, the milestones that being reached that you track as well, which are all part of the portfolio management. So thank you, and for finalizing as well with the constraints and also best practice. That's actually very, very good. We won't be able to take questions right now, but if you are able to stay a little bit later, right after the next session, we will be taking questions as well if you can. And but thank you for your presentation today. I really appreciate it. Thank you. All right, so now for the next session, I will be joined by a panel made up of founders and they are going to be sharing some of their insights into the fundraising journey that they've been having or have had. And they're going to highlight both the benefits and challenges they experience along the way. So welcome and thank you for being here today, Julia and Irina and John. And everyone here? Yeah, great. Okay. I actually want to start off and kick off the session by just asking all of you to tell me a little bit, or tell the audience, just sharing a bit about yourself and your startup offer. And where are you in your fundraising journey so far? So I'll start with you, Irina, if that's okay.
Yes, sure. Thank you for inviting. First of all, I am a founder and CEO of Bank of Memories. So Bank of Memories is a SaaS platform for most important assets of families and their memories. And we are passing on using a blockchain so that all our information that matters can reach our kids, actually. So right now, we've been on the market since I'm from Ukraine, so since the war started, we are on the market. A very probably fortunate or unfortunate time, I don't know, but since then we had 15,000 families already using our product, and we raised our pre-seed round and could have a really good group of angel investors and family offices joining us on our journey. Right now, we are generating revenue, so it's we are flexible in terms of raising the next round. And once we are ready, second quarter of 25, we are going to raise our seed. And right now, we are just growing our presence in Europe and actively working in Ukraine. You can imagine that most people in Ukraine need Bank of Memories, and we became a top provider in Ukraine for memory preservation and these heritage things.
Wonderful. Thank you for that. So, John, would you do the same and just tell us a little bit about yourself, what is your startup offer, and where are you in your fundraising journey? Which I know it's over with, but you tell us about that.
Thanks, Clara, and thanks for inviting me as well. So we are Eventimid. We are a medical device company. The device is for placing tympanostomy tubes in an office setting. So we spun out a company out of a university here in Ireland in 2015. We went through the angel investing route, and we spent most of our fundraising in that area. So we would have used some of the big investment syndicates that you've heard of here today, Iris Medtech, Boole, for our fundraising. And in all, we raised about 7.5 million, or just over 7.5 million over those years. And I suppose in 2023, we were acquired by Karl Storz. So now I'm working with Karl Storz as an employee of Karl Storz at this stage.
Very good. Very good. You probably have a lot to share in your journey to be exit and being acquired.
Sure, a couple of scars.
I'm looking forward to hearing from it. I'll try to tease it off of you. So we have another founder, but she's just getting herself settled. I'll come back to her in a minute, Julia. But what we talked about in the beginning of the investment literacy program in the workshop number 1 actually is about how angels support beyond money and the importance of them also adding value to the startup and the founders. So I wanted to ask you if you could just share a little bit about what kind of support you have received beyond funding, how this impacts your business, and what is, just a little bit about that. That's okay, Irina, if you could start with that.
No problem. I was actually focusing mostly on people who can give me not just money, but give me something else. Give me their connections, their network. It's always like that. And I've heard that many billionaires, they have a rule. When they work with someone, they only work with those who they like. And that's exactly my rule too. I only work with those angels who I personally like, and I believe that it can not just give me money and forget about me. I don't need these people in my portfolio, like angel investors. But usually, for example, we have a Danish family office. So when they invested, on top of their investment, they brought connections to insurance companies where we can potentially sell. And they did warm introductions. They gave us marketing budget additionally to help us test several markets. So that's for me. I mean, not just advice is good, but also networking is good. And we were lucky that most of our investors, they all have kids and family. And I'm also a family person, and we are Bank of Memories. So we are all about same values, and we're all looking in the same direction.
Right. Very good. What about for you, John? And you've had more than one rounds of fundraising, obviously. And I was just wondering that how was your journey with investors, and what did they support your business?
Yeah, I suppose it's a kind of a two-way street. You know, we need to stay engaged with them, and they need to stay engaged with us. And what worked well for us, I suppose, is that as we went through the funding rounds, we started with observers on our board from the syndicates, and then as it went on, some of them became directors on the board, and it served two purposes: one, to give advice and to give support, but also it was really good as well in that the flow of information back to the syndicate was through a voice that they kind of trusted and knew. And obviously then for future rounds, that kind of made future rounds going back to investors, like we would have gone back to our same pool of investors, numerous times. So it made that discussion a little bit more straightforward in that, they had been updating their members throughout the year with how our progress was going. So then when we came back to present or to kind of raise a round of funding, they were, up to speed with what was going on.
Very good. Very good. Irina, you actually want to say something?
Yeah, John inspired me to say something. Actually, I realized that it's like give and take always, and it depends on me as a startup founder, how well do I inform other people about our progress and where we need support, and openly tell them everything. And then I can, of course, get support from our angel investors and that family offices. But if I don't tell anything, because I've heard from many startup founders that they are not even sending updates. That's like, wow, that's crazy. Usually you have to do it every month, at least every month, or even weekly if you are prepared to raise, so that you can get a lot of support from your angels.
Very good.
That's my experience.
Extremely important. And that's it's a two-way street, as you were saying. I can see Julia has joined us now. Hi, Julia. Good to see you. We just started. If you'd like to just introduce yourself, a little bit about what your startup offer is and where your fundraising journey is at the moment.
Sure. Yeah. Sorry for being a little bit late, but yeah, I just arrived to Paris. So my name is Julia. I'm CEO and co-founder of SLab. And in SLab, we work in the sustainability field, where we produce a natural replacement of foam plastic with plant-based components. So heavily involved into the packaging and changing the packaging industry, specifically single-use foam plastic. And in terms of our fundraising journey, so last year we closed our first pre-seed round that was 700,000 euros in total. Mainly it was through angels, syndicates of business angels, and even though we have 2 VCs on our cap table, but those VCs, I would say that they are still business angels or consist of business angels. So yeah, I think heavily working with business angels, and at the moment we started to raise our seed round. That is of course much bigger, and thus that's why we are like targeting actually VCs and not business angels like anymore, or bigger syndicates of business angels.
Okay, great. And for you, like what has been the kind of support that you have received beyond funding from the angels that you have on board at the moment?
I would just echo what Irina and John already said, that it's a huge help, huge support. And I see that business angels are those type of investors who are actually involved, and they actually care about each startup. And let's face it, these are their own money that they put into you. So they vote for you, and of course they would like the startup that they invested into to succeed. Mm-hmm. So of course they get all of their contacts, get to their network, give all the advice, and introduce to next round investors in our case. So we got lots of interaction and introductions from our current investors, and like many deals that we got in terms of customers, and of course investors are actually coming from them. And I would say this has been only a nice and pleasant journey to work with the business angels and those kind of fans that always are cheering up for the startup and making the best usage, and they share all the resources they can see could be useful for us. They nominate us for some awards, they nominate us for the accelerators, and they just keep us always in their minds, which is super helpful. So being a founder is a tough journey, so whatever support you can get is very valuable.
That's great. It's good to know that there's that's a relief, because we know that fundraising isn't easy at all, and there's a reason that it isn't easy, but by having that kind of experience, it kind of keeps you going as well. So that's actually leads me to my next question. And I'll start with Irina again. If you can tell us of some of the difficulties you faced with securing early stage investment, and what have been most challenging so far for you in this fundraising journey? I know you're very recently starting your fundraising journey, so just to see from your perspective what's going on right now and what's been more challenging for you.
You know, from the previous startup, even where I worked as an employee, I could see the same trend. It happened to me, and it happened to that previous startup, that when you're only beginning and you are looking for first check. So first check is always your own check. So it was my check, it was my husband's check, and my family check. That's how we started. But then, of course, you're trying to tell people what you're building and trying to inspire them, and they're always looking who else is there. They don't want to be the first, and that's maybe John can also confirm that when you're raising bigger amount of money, they always want a lead investor who is not there, and it's always like a big challenge to get the first check or first person who will believe in you. But I've heard many times, and also from Tim Draper, who is a Silicon Valley investor and also our mentor, what he said, that you always will be fighting to get that one person. You don't care about other people. You just need one person who will believe in you, and then after them everybody will come and give you money and give you connections. That's a first dollar. The first check was very difficult to get from random people, from those who I didn't know. That's the first challenge. And probably the second would be to inspire our own team. So of course we had a couple of people who were already inspired, but we needed more developers, and we needed them to keep going like full time, to be really inspired. And it's also a challenge to work with this kind of people, so they could easily go to the market and get the highest salary and have luxury life. But now they have to work very hard every day for a little startup that might be successful in the future. Of course, for them it's really risky, and for me it was a challenge to motivate them in the beginning. But once they saw first success, they were like, oh yeah, we can be like Elon Musk. Well, we can be well, Elon Musk may be like, okay, someone else, some other people. Okay,
so very good, very good. So yeah, I'll send the same question to Julia then, if that's okay. Julia, if you could answer what are your challenges on fundraising?
Yeah, I think same challenges, of course, in every startup, in every journey. So I would like, on one hand, we got oversubscribed in our previous round, so we aimed to raise 500,000, which already was like a quite ambitious goal for the pre-seed round, and we ended up raising 700,000 euros. So we actually 200,000 more. So of course, at the end, it looks like it was a very successful round for us. But in reality, it took like a year to actually fundraise from the moment we started fundraising and then till closing the round. And it's quite a long time, especially when you have to build at the same time product, you have to build customer base, you want to raise awareness, you want to improve the technology, you want to do patents and all the legal things that come in. So like it's just a lot of things that happen at the same time. And on top of that, you have to fundraise. And this is like fundraising is already a full-time job for a founder, for CEO, or for whoever is in charge of that in the team. And then having this full-time job, you also have to do all the other things, like build the team, build the product, build the technology, then manage the team, manage the tasks. And for us, it was like a big jump from being founders and doing everything by ourselves, and then growing the team, which was like, we were very excited to do that. But then you realize that you have to not manage yourself, but manage other people. And this is another type of a challenge. And even though I've been managing people my whole career, still this is a different level when you have to overlook so many directions. So basically you have to keep everything in focus and just juggle with those balls in the air, and try to make sure that you take care of the one that is in your hand at the moment. So yeah, just lots of things happening at the same time, and finding the right people. So like as Irina said, the same for us. We didn't want to have investors like random investors. We wanted to be aligned with them, with their goals, and we were like targeting those who do invest in impact, in our case, in sustainability, who actually can contribute to what we do. And this was like also one of our kind of requirements for the investors. We were looking into them as well, what in terms of what they can bring to the table and bring to our startup. So of course, like, I wouldn't say that we were too picky, because I wouldn't say that we were connected with some like inappropriate investors too much, but there were some cases where I had to turn down the term sheet from the VC when I understood that there is no alignment with values, and I saw that this could be a very, like, they would give us money right now, but at the end it would be a very bad thing for us to take those money, because like they would take control of many things, and it was not beneficial for other investors actually to have this investor on board. So like that kind of things. And then also when it comes to the human to human interaction, if it doesn't sit right with you, you like as a founder, you have lots of challenges, but this is like the big thing, that you can choose who to work with. You can choose who to hire into the team. Then you can choose who to take money from, who to onboard as your investor, and to look into them as your potential type of resources. So yeah, I would say like in a nutshell, the challenge is that there are so many things and so many moving parts at the same time.
Yeah, no, thanks for that. And you actually raised a really good tip there, a good point in terms of it can be a challenge to say no to money on the table, you know, and especially when you're in that space of needing it. But John, I'm going to move on to you. And I know that you've had a few rounds. Would you tell us how many rounds? And also just a little bit about, you know, the challenges you faced, and did it get any easier over time?
No, definitely didn't get easier anyway, that's for sure. I suppose we had kind of 3 standard rounds, and then we went into low notes towards the kind of the back end of our timings. You know, we went through about 2 or 3 different low notes then at that stage, kind of towards the end, as we were trying to bring on bigger rounds of funding, and then, you know, the acquisition came along. But I would say kind of what Julia said there, the timing, the biggest piece of advice I could give people from a fundraising point of view is the timing. It always takes longer than you think, you know, from, you know, fundraising, meeting people, kind of following up. Then once you get to a stage of term sheet, then you've legals, and the legals can go on and on and on. You know, the things can pop up in due diligence, things like that. And I think what we did quite well, and to founders out there, is to know your burn rate. You know, I would have said, you know, the day that we brought money in, you were nearly back out thinking about the next round of funding, because, you know, if you have 6 or 7 or 8 people and a burn rate, you know, of 100,000 a month, you know, the money goes down quite quickly, and you need to factor in, you know, at least a year to fundraise, even though the actual, you know, the meetings and things might only happen at certain times of the year, but, you know, you might have one meeting and then another meeting a month later. So things just take longer than you will think. So I would advise people to give enough time to the fundraising and the legals and the due diligence after it.
Very good. Very good. Yeah, thanks. That's a good tip. A very good tip there. And I'll just, as I have you there, I'm going to ask the next question to you, as just if you could share a little bit about the relationship with the different angels that you've worked with. I know that you are now an angel investor too.
Correct, yeah.
both seats in a way in this panel here. So yeah, from the point of view of a founder relating to angels at the time that you did, yeah, I just wondered how you kept them engaged with so many things going on at the same time. Was it difficult to manage a big group of angel investors, you know, as you went along? Yeah, and the amount of updates that you had to supply them with, and, you know, like, is it a realistic ask?
I suppose we have a few scars from going both ways. We actually set up a nominees company as well to kind of almost set up our own group of angels, you know, because there were guys that were outside angel syndicates, and we then set up an entity to kind of have them all in one entity. But looking back, I don't think it was the greatest idea. You know, it was nearly more administrative work on our end to kind of manage those people. But what I would say is the advantage of the syndicate is that they're very efficient. You know, we had Medtech, Iris, and Boole, and you know, in general, you were dealing with one person in each of those, and a lot of the time, that person was on the board, so that person was very well up to date on what was going on in the company. It was easy to keep them brought along from a due diligence point of view, from a legals point of view. You know, you were one point of contact, whereas we had a few kind of angel investors on the cap table that would have been, you know, singularities on the cap table, and they were nearly more work to kind of keep coming along. You know, they were the same level of work as the whole syndicate, if you know what I mean. So it does benefit you in the long run to have those syndicates or those organized setups rather than taking individuals one by one, where they will then, you know, you will need to bring them along as much as possible. But from an updates point of view, then, you know, we would have updated quarterly. You know, we would have given updates. We would have certainly had board meetings, you know, 6 to 8 times per year. So there would have been lots of updates throughout the process to certainly the syndicates.
Perfect. So it didn't get easier at all to manage.
No, but I think, you know, words, you know, when I did start to invest myself, you know, you're in it for the journey. A lot of, you know, investors going into this, you know, if they want to make a 6% or a 10% return, they'll go and invest in Apple and invest in these other, you know, a lot of them are in it for the journey. They realize that the level of risk in, you know, in early stage companies, but a lot of them want to just hear and get involved. Some of them, you know, invest and they want to hear what's going on. They want to give their advice. So I would utilize that. You know, a lot of people think, you know, they invest and they walk away. I think the angel investment is a little bit more involved, that, you know, they're investing in a very high risk area because they want to, and because they're interested in that area. They're interested to hear what's going on, the progress, things like that. So it is beneficial to kind of reach out to them and, you know, ask for their help, because they're probably more willing to give it than an investor that's investing in, you know, the Apples or the Amazons of the world. They just want to put their money in and let it grow and walk away from it. Whereas these guys are a bit more interested in the journey, I suppose.
Gotcha. Thanks. Well, Julia, you tell me, I mean, I don't know how big your portfolio of angel investors are right now, but if you could share a little bit about the, you know, the relationship that you have with them, how you manage the different angels that you've got. Are they all in syndicates at the moment? How does it work with your, you know, many balls that you're juggling there?
Yeah, I would say we have all of the combinations that you can imagine. So we have individual business angels who invested like single ticket. Then we do have syndicates, 2 syndicates, and then we have a VC that consists of 3 business angels. So they technically are considered as a VC because they, you know, collectively put a fund, and then they are investing through this fund, but still the decisions are made with those 3 partners, and I will still call them business angels. So yeah, I think we have all of the possibilities, individual syndicates, and then VCs that consist of business angels. And yes, of course, like on a base level, we send our monthly, sometimes bi-monthly, sometimes quarterly updates. So I will be, you know, transparent on that. And like sometimes we're not doing the best work there, but at the same time, we keep a very close communication with them. So we do talk in WhatsApp, exchange messages, quick calls. So like, yeah, we have a foundation where there's like, you know, regular updates, but then we have a bit of very informal communication where, again, they can send me a message anytime. I can also send them a message, have a quick call if I need an advice or to discuss a specific topic. So I pick the business angel that has experience or relevant experience on that to talk about some things. So this is like, you know, formal and informal. And then at the same time, we have some meetings with them, most likely quarterly or once in a 6 months. to also discuss our progress. But of course, like the simple thing is that they all of those business angels are following us in LinkedIn, and they do like our posts, they comment something. So even this, is boosting our visibility in social media. Like this kind of a simple support. So yeah, try to keep this relation formal to the extent where we need to do the updates, but then informal where we can reach out to each other and talk about any topic business related, and they can do like a quick ad hoc help or support, and then introduce and think of us in any moment.
Very good. It's great they have access through WhatsApp as well. It's an interesting format. I wonder if you can keep it up with the next round though.
Yeah, definitely it's not a sustainable model, I'm sure. But yeah, so like last round we had several investors, so of course it's not like it's several people to manage. I would say manage their expectations, manage our expectations from them, and in this round we are taking lessons learned, and we want to have like less investors, like less entities. So maybe with less investors on board, but in this round we can still keep this type of a communication if that's not too many investors coming on.
Great, thanks. So for you, Irina, like how would you answer this question just in terms of your relationship with your investors, how you bring them in as well, and what are the updates that they require, and how do you go about that?
We with them, as I said, we are mostly like friends, because I believe that will be just a strategy in the future too. I've heard from many startups that it's really hard for them to manage, so they really enjoy that when the check is coming and then they start working and focusing on their work. But for us as a family company and around family, we are very focusing to find people we like. So we are talking to all of our investors anytime, as the same as Julia said, WhatsApp calls and a meeting at the conferences, and then the investor is taking me by hand and just I'm following him somewhere, and he's saying, hey, you have to meet this and this people. So people are wondering what I'm doing at the conferences, and in fact, there's a secret plan. So I'm meeting all the new potential investors, and I'm learning about them with a high precision, and I really try to understand who will be the best fit for me and the best person for me. So in the future rounds, I believe if we are getting like an investor fund, then of course I would know them in advance. So now I already know a couple of those who will be the part of my round in 2025. And I try to keep that cozy atmosphere as long as possible. I don't want that culture that will be like using startup founders until they die, and it's not sustainable. And we have to really keep good relationships and not toxic. Even though I had one relationship with an investor who was really pushy and a little aggressive, so I understood that I made a mistake, and I don't want the same mistake in the future.
Very good point. Well, since I have you there as well, I might as well ask you in terms of for investors that are considering angel syndicate participation right now that are in their audience, what do you think they should understand about supporting companies from an early stage through to an exit? What would you suggest based on your experiences so far? Irina.
You're asking me. So I think that most people already know this, so that's our kind of basic things, and they understand that even though they're in syndicates, it's still. I agree with you that maybe people, some of them are just not knowledgeable. That's why we have this kind of webinars to inform them. But in fact, when they are joining syndicates, that's because my family is in the syndicate, so I know that usually they inform the guys. So here are the terms. But if in case you can help someone. So here are all the details. Let us know. And most of managers of the syndicates, they want extra support. It's not just give me your money and we'll manage your money. It's not enough. And all of syndicates, they are all competing, of course. In every country, there are syndicates and they are competing. And the best syndicates in the end of the year, like all startups know about them. So if you're not making any extra effort, your syndicate will not be the best.
Right. So there's the word goes around as well as an angel investor. The founders talk about it. Is it?
Yeah. We do have blacklist of investors. We do have we know everything. Yeah, all startups now.
Okay, so Julia, thank you for that, Irina. And Julia, no, the same question to you in terms of like, for those considering angel syndicate participation, what should they understand about supporting an early stage company? And, what are the, based on the challenges that you talked about as well, that would be good to mitigate, what would you suggest that they are, that they know at this point, and.
Yeah, I would definitely then again echo everything what has been said, that it is human to human first. We work with people, even though we create products. For products, we build technology, but all of that is done by people, by actual human beings with emotions, with personal stories, with challenges, with families, and so on and so on. So this is, I think, the first thing to take into the consideration, that founders are people. Even though I really often hear that we are superhumans, because it kind of seems that we have 72 hours instead of 24 hours in our day because we do so many things. But this is a constant hustle, where you juggle again all of the things and you make things work. Often have few meetings at the same time or meetings back to back, and so I would say that this is the biggest thing to support founders' journey. And I'm happy to say that many investors start the conversation with me with a question: how are you doing? How are you feeling in terms of burnout? Aren't you turning to be burnout? So this is the question that I've been asked by our investors. So they do really care about ourselves, about us, about the founders. So I think without the mental health, mental stability, motivation, internal motivation, and all of those factors, you cannot actually build a successful startup. So I would definitely suggest business angels to look not only into the indicator KPIs and traction and so on, but also look into the how you can support a founder as a person. So this is probably my biggest advice, because all of the other things, they would come naturally from business angels, help with the customers, introductions to the investor, thinking of your startup, whether there is an opportunity for them in some conference or something like that. But just build this relationship first and think of the founder as the person, because idea of the startup can pivot and it can be something different, but if you maintain the mental safety of the founder, then they are able to build something even better. And we know many startups who pivoted from what they've been doing originally, but they've been getting support from the investors and they were trusted. So this is also other thing, that you have to trust your startup and the founder of the startup. Since you already invested into this team, into these founders. So continue just trusting and supporting, and maybe if you have some suggestions, of course, bring them up. But keep this human relations on the first place.
That's really good. Thank you for that. John, so you have had scars, you said, and in relation to the scars, in relation to your relationship to angels at this point, and you had a chance to, give suggestions of what they could do differently in order to avoid the scars there. Would you have anything that you'd like to share here about this?
Yeah, I think in a startup, you have that famous image of, what you think it's going to be, the straight line from, startup to exit, and then it's not. It's climbing mode. There's always going to be challenges and the unknown unknowns. So I think, kind of to echo what the two ladies said, it's tenacity is the biggest, I think, for founders. And now, as a kind of an investor, what I'd really look at is the team. You know, is the team going to stick with this? Because what you want is the founder to stick with this until the end. Because, you know, if the founder leaves, the drive leaves, the heartbeat of the company leaves. So you want somebody that's going to stick it out, that's going to stay with it. And I think you'll always have the scars. You know, if you get through something without a few scars, there's something wrong, or you've done. You know, I don't think you can. I think there'll always be challenges throughout the process. But I think the team is vital. You know, the early founders, and having a co-founder, I think, is very important as well. It's one thing that kind of we had, you know, things that we hit by accident nearly, you know, as to what sector we went into, what, you know, area we went into in the medtech sector, but also having a co-founder there as an entrepreneur is very important, I think, because you can kind of bounce stuff off each other. You know, it's good to have a sounding board. It's good to have somebody who cares as much as you do about the product or the company. And it just makes the whole process that little bit, I suppose, more, you know, it's a problem shared as a problem halved, you know, that kind of way, that you can always kind of bounce stuff off them without feeling that, you know, you need to hide anything, or that things mightn't be going as well as you should be going. You know, that it's very important from that point of view.
Very good. Do you think it weighs as well in terms of the angel investment if there is a co-founder involved?
How do you mean?
Does it weigh on the decision of investment from an angel investor if there's a co-founder as well? Do you think that has a good?
I think for me, it's seeing a co-founder, seeing somebody doing it on their own, I think is more difficult. I think having, you know, from my own experience, I had a co-founder, Oliver O'Driscoll, you know, who founded the company with me. And, you know, it was always good to have. And what I would say is that if you do have a co-founder, it's always good to have somebody in a different area. You know, you don't want mirrors of yourself, because you're just looking at the same area and bumping into each other in the same sector. So what was ideal is that, you know, Oliver was kind of in the clinical side, I was more in the engineering side, and we were able to kind of look at different areas. And then when it came to investment, you know, two eyes on documents, two opinions, or two kind of viewpoints on, you know, the legal documents was always better than one. And then you had that sounding board, you know, to kind of sit in a room and kind of strategize as to where you wanted the company to go and what you wanted it to be, was always, you know, very beneficial.
Awesome. Well, look, we could keep talking for a while, because there's a lot of elements I would like to pick out. As it seems very positive, the journey you guys had so far, and I really wish Irina and Julia a wonderful new round, and that may it go on smoothly. And John, thank you so much for sharing your experience as well, and you know, and yeah, sharing your expertise and insights with the group today.
Thank you.
We're going to finalize now, and yeah, thank you guys.
Right. Thank you, guys.
All right. Thanks,
Thank
John.
you
Thanks, Julia. Thanks, Irina. Yeah, we're just going to give a look at the Q&A as well here. Look, it's been brilliant actually today. There's been a huge amount of questions asked by everybody, so thanks so much for all of that interaction. I think we've most of the questions we've managed to actually answer during either directly, we've kind of written answers in the Q&A directly, or we've asked some of the questions to the panel discussions on the way through. There is one question there that is still outstanding, and if we have if Ivan is still with us on the panel. Ivan, are you still there?
Yeah.
You are. Okay, good man, perfect. It's a question around patents, which obviously for deep tech companies is critical, and I know you guys deal with deep tech all the time. I don't think you can answer this question specifically, because the question asks whether it makes sense. Is it better for raising investment to have a patent registered in a new company, or to keep the patent in an existing company that has a history of already operating? So really, to answer that question, you need to know what that company is, that existing company. But just talk to me just on a different level about patents, how important they are to your decision to invest in deep tech companies.
Yeah, and I'll jump on this question after, because I actually faced that challenge. No, in terms of patent, it's key in medtech. You cannot really invest unless you are sure that the technology is protected. So that goes through patent, freedom to operate, making sure that the founders have discussed with some IP lawyers. So this is very important, and you'll want to have that done on founder standpoint before you talk to any investors, or at least to have a path to make sure that you will look at and protect your intellectual property. It's always also a balance between trade secret and IP, but in our world of medtech, because we know that at some stage the company will be sold by a big player, the IP is just more important. You have to be protected with a patent. The patent is key.
Yeah, I think that is the key point. Is we often dealing with startups with my Access big hat on. A lot of startups will talk about, well, firstly the expense of putting a patent together, and secondly their practical inability of defending a patent if someone infringes on it while they're still a startup. And often that's not the point. The point is that the patent exists and the acquirer of that technology has the patent to defend at a later stage. So it's not necessarily that the startup is able to defend it practically during the startup phase, but it's there for future protection for the acquirer down the line.
Yeah, no, definitely. And it's for an investor standpoint, it's just reassurance that there is some technology that is protectable and protected behind the money you're putting in. So it's key. Regard the question, it's as you mentioned, you need to know the company. I think what's important as an investor. So it's always a bit easier to invest in a company that has limited history, because the due diligence, you don't have to look at past debts or loans or this type of information that could be a weight on the company. And if it's a new company that's very short lifespan and have some maybe just history with an incubator or with university, it's easier for investors. But again, every situation is different. So yeah, you need to know what the company is and what the history is about.
Yeah, no, absolutely. Okay, Van, thanks a million for jumping on there and answering that. And again, everyone, thanks for all of the questions all the way through. I did undertake to send on a due diligence questionnaire as well as part of our follow-up. So we'll do that to everybody who registered on today's workshop. So I'm just going to hand you back to Clara, who's just going to wrap things up here for us. And from my point of view, just thank you so much for coming along today and through the other workshops. This has been a huge body of work for us, and we're delighted to bring this body of work to you. And we hope that this has helped to increase the investor literacy of as many people as possible. All of these workshops have been recorded, and we will share these recordings. And we're going to do all of this again next year, and we'll let you know about the dates when we're going to do that again next year. So we're going to run this program again for the next wave of would-be angel investors. So great, Clara. Thanks so much.
Thank you so much, Larry. No, that was great. I'll just have a quick refresher and recap, because we covered a lot today. So we covered about what is deep dive session, what happens after the pitch, and how that streamlines the deal analysis and decision making. We also had a great session by Anna on due diligence. It was covered in detail exactly what items are covered in analyzing a startup's viability for investment. And we also learned a lot about the deal lead, or the process of sharing insights from both the angel founders and managing the data rooms with her. Our panel was also so great and gave us a lot of insights in terms of decision making and how they support the startups and keep them updated or receive updates from them, and building the trust. So great tips were given by them. We then introduced the critical documentations that are needed and the prospects of negotiating and closing a deal. And that was explained by Michael today. And, he even spoke about how angel investor is like a patient capital investment. So, it's for the long term. And he walked us about the ownership split and share classes as well. We also covered how syndicates go about portfolio management, the stages, the sectors that the angels are interested on, and how you work with these members' preferences. Ivan also explained a little bit about the deal flow and how it all makes part of the reporting, and how portfolio management is not just one thing; it's several things that make it up. And in our last sessions, you heard firsthand from founders who are currently fundraising and who have gone through the several rounds of fundraising and all the way to exiting. So you got a lot of tips from them, and how they also need your support as if you're going to be angel investors, and to watch out for them as humans, and also how they have a lot to be juggling. So to just be mindful about supporting them in any way you can. So yeah, so for the last bit of the session, I just wanted to welcome you again and invite you to come into our introduction to demo days. Once again, we have it up on the slides here, the dates that we're going to be having Ukrainian startups pitch for investment. These are deep tech innovative solutions and great potential opportunity investments for you. So Sweden will be hosting the next demo day in November 28th. And we have the times there, CET time. And also my colleagues here from Access BIC are going to be running a demo day in December the 5th. So yeah, watch out for those and register to those. The link is on the chat box, as mentioned before. And yeah, I want to say thank you for the speakers and all the participants for sharing this morning with us. And we hope this was valuable content for you and that will support you in your angel investment journey. Thank you very much and goodbye.